Yeah, good morning, friends. Last session we had on 17th, we discussion on topic of depreciation, section 32. I'm taking you forward in this head of business of income from business or profession. We start with section 32 AD investment allowance, which is available specifically for industries in the notified backward areas of Andhra Pradesh, Telangana, West Bengal, and other areas. This is a specific deduction which is allowed under section 32 AD while computing the income from business or profession. Just let's see the eligibility criteria for this investment allowance. Any SSA is eligible. You should be engaged in the manufacturing. You should acquire any new plant and machinery. Commencement during the period from 1st April 2015 to 31st March and 15% of the actual cost. So these are general conditions which are very easy to understand, but the point which I would like to highlight here is that this 15% under section 32 AD, though based on the cost of acquisition of new plant and machinery installed in industries, manufacturing industries in the backward area, is not to be reduced from the written down value. So, and second, even if the asset is used for less than 180 days, still you will be eligible for 15% full deduction. So these are the two things which are not in sync with deduction under section 32, because section 32 depreciation allowance will be reduced from your cost or WDV for further calculation of WDV the next year, and similarly 50% of the eligible rate you will be entitled to if the asset is used for less than 180 days. This is the case under section 32 depreciation, but the same is not there for investment allowance, which is under section 32 AD. So this difference should be noted by you. Then the another condition is that such asset should not be sold within 5 years from the date of acquisition, otherwise you lose the exemption. And definition, which is not a new plant and machinery, is same as section 32(1). That is, those criteria will similarly apply here for section 32 AD also. Now the next one we are taking in sequence is section 35. I have reproduced the chart which is available in our study material manual with respect to the expenditure allowable under section 35, expenditure on scientific research. Now, this is from the examination point of view. If I look at this section, then for those people who are appearing in November 2020, for whom the assessment year is 2021, the things are going getting a little complicated. But those who are going to appear for the subsequent attempt where the assessment year is 21-22, this section is going to be significantly simple. Now, why? The reason is that there are about 10-11 deductions which are available. Deductions for expenditure incurred by the assessee on scientific research, and deduction in respect of contributions made by the assessee to various research institutions, colleges, etc. that we are going to see. Now, with respect to these two types of expenditure, there is first problem is to remember from the examination point of view. The first problem for the students would be which of the expenditure is eligible for 100% expenditure, 100% deduction, and which of it is available for 150%. That is, a weighted deduction is available for certain expenses or certain contributions. Now, this distinction makes the issue complicated for the students from the examination point of view, and therefore this complication of remembering the things remains for all those students. But from assessment year 21-22, this additional enhanced weighted depreciation of 150% is to go, and for all types of expenses, revenue, capital, and all types of contributions, the eligibility will remain, but the deduction will be set to 100% across the board. There will not be any distinction between 100% and 115 weighted deduction for certain payments or certain contributions. So, but we have to live with it for this year's, that is November 20 attempt. You will have to have this live with this problem and difficulties. What I have done is that this is instead of presenting it this way, this is just a representation in the from the manual of our institute. I have tried to make it slightly simpler from the examination point of view, so that you are able to remember it in that sense. And try to understand there are two different categories of expenses. One is that I incur myself an expenditure, and I am entitled for that expenditure on scientific research, and I contribute to or I donate to certain institutions, and for that I am eligible for deduction. And the deduction percentage is slightly varying, as I told you, either it is 100% or it is 150%. So I hope this will be of some help to you, to the way you should remember in the examination, because MCQs mostly they are asked testing your knowledge, in-depth knowledge about this distinction between 100% and weighted deduction of 150%. So the nuances, small details have to be understood by you from the examination point of view. They should be properly registered with you. Particularly in the examinations, in a hurry, you are, because of the this tension or whatever things, you get confused, you get the lot of confusion, and that needs to be removed, and you should be very crystal clear about the deductions that are available. And from that perspective, I had tried to make an attempt to make you enable or rather to simplify for you to remember the types of deductions that should be available, and you should be able to distinguish between 100% and 150%. That's how, and that's why the rows or the rows of the tables are colored separately. First is that I'm an any SSE, means I'm earning income from business or profession. I'm not necessarily a company or any other form of organization. I'm any SSE who is having income from business or profession, and I incur any revenue expenditure or any capital expenditure other than that, or other than land, on scientific research which is related to my business. Look here, first two, 35.1 and 35.1.4. Here I am any SSE, expenditure I incur, it is revenue expenditure or it is capital expenditure other than on acquisition of land, and the expenditure has to be related to my business. Then I am eligible for 100% deduction for this expenditure. Any SSE related to my business, revenue, capital other than land, I am 100% eligible. This is one. Now the second category, which is in a slightly faint blue color, faint pink color, you can see. Now these are notified approved associations, college or other institute, other universities. Notified approved association, college or other universities. Now here both ways I contribute to them. I give contribution to them. Notified approved association, college or other universities, I give contribution to them. Now the contribution can be for two reasons. One, for scientific research, you can see here scientific research, and the other for research in social science or statistical research. So one category scientific research, another category research in social science or statistical research. See, I am giving contribution. I am any SSC. I am giving contribution to notified approved association, college or other universities. The only difference is that I am giving contribution for scientific research. I am giving contribution for social science or statistical research. If scientific research, 150%. If social science and statistical research, 100%. So scientific research gets more importance, so 150%. But social science and statistical research, I get 100%. So this distinction you can remember. notified approved association, college or other universities, but difference between 150% and 100% is if it is for scientific research, 150% weighted deduction. If it is for social science and statistical research, 100%. Try to remember this, right? Okay. Next one. If I am an approved Indian company, if I give contribution to an approved Indian company, remember this, approved Indian company for scientific research, any contribution I give, then also I am eligible for 100%. Okay. Now here it was notified approved association, college or other universities. Okay. Mostly these are the institutions not for business but for charitable activities or research kind of thing. But an approved Indian company, maybe it is only research or maybe it is doing business in research. For them, if I give any contribution to an Indian company for scientific research, I'm coming back to 100%. Okay. And now the last two categories, 352AA and 352AB. Understand this. Both of them enjoy 150% weighted deduction. Approved national laboratory, IIT, university, if I give contribution to them, scientific research and approved program. Approved national laboratories, IIT or university, scientific research and approved program, 150%. And expenses incurred by a company engaged in manufacturing, biotechnology, but these expenses have to be expenses on approved in-house research and development facilities. So I should be a company, I should be engaged in manufacturing or biotechnology business, and I should have approved in-house research and development facility. If I am such a company and I am engaging myself in this approved research and development activity, in-house research and development activity, and I am a company, then whatever expenses I incur on these activities other than land and building, I will be entitled for weighted deduction of 150%. Okay, so we see here that there are different categories, mostly similar of nature. I need to find out the nuances and small things of distinction between these categories and try to understand which one are eligible for 115 weighted deduction and which one are eligible for lesser, that is normal 100%. Now whatever I told you in the beginning, that whatever weighted deductions are available 115%, they are going to go from assessment year 21-22. They are not there from assessment year 21-22. So in all these categories it will be 100% only. Right? So probably you may not have to remember all this distinction at that time for the assessment year 21-22, but for assessment year 2021, which is your assessment year for the November 20 examination, you need to remember this distinction. So here we are, once again we get into this. I am any SSC, revenue, capital expenditure other than land, 100% expenditure I incur. Notified approved association, college or other university, contribution, scientific research 150%, social science, statistical research 100%. I am an approved Indian company, scientific research contribution given to such Indian company 100%. But approved national laboratory, IIT, university, scientific research and approved program. Okay, it is an approved program, then 150%. And expenses engaged by expenses by a company engaged in manufacturing or biotechnology business, if they have approved in-house research and development facility, any expenditure incurred by that company on such approved in-house research and development activity or facility, such expenditure other than on land and building will be entitled for 150% weighted deductions. Okay. Now we will see what are the other conditions with respect to section 35. As I told you, both revenue and capital expenditure other than land will be eligible for reduction, and the expenditure which is incurred not only the previous year but also 3 earlier years on salary and material inputs from commencement of business is allowed. So when you commence the business, before that 3 years, whatever expenses on scientific research are incurred, but those are limited on the category of salary of the personnel involved in this scientific research and material requirements of the scientific research. 3 years before the commencement will be allowed. Expenditure and loan is not allowed, I told you. No time bar for carry forward of unabsorbed scientific research expenditure. You have a lot of scientific research expenditure done. You could not set it off in the year of commencement of your business. You can carry it forward, but just like depreciation, unabsorbed depreciation, there is no time limit for carry forward of the unabsorbed scientific research expenditure. And second, as we are claiming 100% depreciation with respect to, 100% deduction under section 35 with respect to various capital expenses other than land, then the condition would naturally be there and is there that no depreciation on capital asset on which such deduction is claimed will be allowed to you. Then the deduction is restricted to 100%. This I told you that deduction will be, that sunset clause of 31st March 2020 is there. So weighted deduction will not be available from 21-22. Whatever I just told you in the previous chart, which are the deductions which are entitled for 150% weighted deductions, those weighted deductions are going to get obliterated from the assessment year 21-22. Things are going to be simple from the examination point of view for all the students from that assessment year, but for November 20, we will have to understand and study all this. That's fine. Now, if next issue which we should understand is if the capital asset which is used for scientific research on which we have claimed the reduction, there are two categories that we make, that asset is used but asset purchased but not used for scientific research. Then we have these two categories as to what happens when the capital asset is sold. Okay. Now here we have, I have given you in a table format trying to understand and make you understand this, that sale consideration less cost of acquisition or written down value, as you know that will not be nil. So because expenditure on the capital expenditure on the asset which is used for scientific research, you will be allowed 100% deduction. Now because you will be allowed 100% deduction, you will not be allowed any deduction for cost of acquisition or written down value. The entire amount would be, entire sale proceeds would be taxable. And if the asset is so used but it is not so purchased but not used, then sale proceed plus deduction under section 35 up to cost of acquisition. So you are allowed certain deduction under section 35 even if the asset is not used, and sale proceeds, then that deduction up to the cost of acquisition will be considered to be income from business or professions, and anything above cost of acquisition, that will be taken to be the capital gain. That is the distinction between the capital asset which is used and capital asset not used for scientific research. Okay. So this is with respect to section 35. Okay, now I have some questions. Let me handle these questions first. Pooja from MP is asking me a question. Depreciation in case of succession of firm's sole proprietary concern. Yeah, this is regarding the depreciation. Succession of firm and sole proprietary concern. We have discussed this. It is available in the proportion of number of days in the year. If the total depreciation available, say for an asset is say 10,000 rupees, and I am using that the succession takes place say on 30th of September, and let us assume that it is equally, so that a proprietary firm will get 5,000 rupees which gets converted into a private limited company. So that private limited company will be eligible for remaining 5,000 rupees if it is to be distributed equally. Actually, it should be in the number of days. So 10,000 rupees divided by 365 into the number of days for which the proprietary concern, sole proprietary concern or the individual is having the asset, and the days which are there after the conversion. That is how we should go. Next, Ria is asking question. Additional depreciation at 35%, section 32(1)(2)(a). Please explain this page. Page number 4.218. Okay. Now this section, I can explain you this. We had discussed this last time, that additional depreciation of 35%. Normal additional depreciation available is 20% for all the manufacturing units when the new plant and machinery is installed after 1st April 2005. So the additional depreciation available in normal course is 20%. But if the industry is located in backward industrial areas, specified backward industrial areas like, if I remember it right, Telangana, Andhra Pradesh, West Bengal, Bihar, and some part of Kerala also. So these are considered to be industrially backward areas, and to promote the industries in these industrially backward areas, the government has given this additional incentive whereby instead of 20%, you will be given additional depreciation of 35%. You will be given additional depreciation of 35% on the new plant and machinery which is installed. That is what is additional depreciation at 35%. Riya, I hope I have explained you. Now Rita is asking me research expenses by IIT on themselves. Now research expenditures on IITs by themselves, they will fall in the category of 100% depreciation, because IIT in that case is any SSE and I am incurring any expenditure on scientific research. So in that case, I will be falling, if as an IIT, if I do expenditure incurred, I am not eligible for 150% weighted deduction. I am eligible for 100% because it has to be a contribution. If I contribute to IIT on the approved scientific research program, then a contributor is eligible for 115%. IIT themselves incurring expenditure, they will fall in the first category, 35(1) or 35(1)(4), where capital expenditure other than land or and it should be related to their business. That is one more thing. So that is what, these are the conditions to be satisfied by them to be eligible for the deduction. I hope I have explained all the queries for the time being. Now, yeah, there is one more question from Pooja from MP. She is asking, sir, please explain terminal depreciation once again. Okay. Now, terminal depreciation, as you understand with the word terminal, the end of the asset, when you stop using the asset, when you discard it, when you scale it, or when you scrap the asset. Now, this terminal depreciation, this concept is applicable only with respect to power generation units who are entitled for, who opt for, rather, not entitled to, because they have the option. They can go for Appendix A or Appendix 1E. What is Appendix A? The return on value depreciation method. And Appendix 1A is straight line method for depreciation, which is a special category of depreciation exclusively available under the income tax rule for power generation units, power generation assessors, those assessors who are engaged in power generation distribution category. So they can opt for straight line method depreciation as per Rule 5. And once they opt for this straight line method of depreciation, which are slightly on the lesser, the rates are a little lesser because straight line method. So if they opt for straight line method, when the asset is, the option has to be chosen in the year in which you put the asset to use. Once you choose the option of straight line method, you must continue with that option will continue. You will have to, then it becomes compulsory for you. Once you have chosen, it becomes compulsory for you. Now, if down the line after some years, suppose an asset worth 1 lakh rupees, you have depreciated it and the return on value now remains in the books 20,000 rupees. But now the asset is to be discarded, it is no longer usable, and therefore you have to discard it, you have to scrap it. So how much amount you get? Suppose you get 5,000 rupees out of sale from this asset. So 20,000 is return on value, 5,000 is the sale proceed of the scrap, remaining 15,000 is your terminal depreciation. Now what happens, is the deduction available to you for terminal depreciation? The answer is yes, provided you satisfy the condition that this terminal depreciation is actually written off in the books. So you have to write off this asset balance of 15,000 rupees in your books. So you will be entitled for this terminal depreciation in the in the computation, provided you satisfy all these 2-3 conditions. You are power generation, distribution, you have opted for rule Appendix 1A, that is straight line method, and there is some return on value in your standing in your books, and still the standing that return on value available in your books. You discard the asset, you scrap the asset, and there is some balance remaining in the in the asset account, and that you have to write it off, and that would amount to terminal depreciation, and you will be entitled for that entire amount of depreciation in the year in which you scrap or discard the asset. And similarly, I have been asked the question regarding the balancing charge by Palak from Goraya. The balancing charge is a reverse thing. That is, this 15,000 worth of 20,000 worth of asset, if you sell for say 30,000 rupees, this 10,000 rupees is the balancing charge, and that is liable under section 41 for tax. So that is what you have to offer that for tax, that is balancing charge. Now that what is the difference? Balancing charge is getting taxed under section 41 as business or income from PGBP में वो tax हो रहा है. लेकिन if your normal SSC, there is a return on value and the block gets exhausted and there is surplus remaining after selling certain assets in the block, then that surplus is taxable under section 50 deemed short-term capital gain. That is the difference. Balancing charge, business income, and in any other case, if it is sold and there is a surplus and the block of asset is exhausted, then that surplus is chargeable as deemed short-term capital gain under section 50. So that is the depreciation. Now, there is one more. Aditya Gupta is asking from Varanasi, additional depreciation is allowed only in year of acquisition or for useful life of asset? Yes. Additional depreciation is only one-time allowance, only in the year of acquisition. Only in the year of acquisition. This is an incentive. This is simply an incentive given for acquisition of new plant and machinery, and therefore you are entitled for only once. You can claim it only once. Yes. Kristen, you are asking me, we can't put 15,000 as loss on sale of asset. This is, what do you mean loss on sale of asset? Do you want to claim the deduction or not? Anybody would want to claim the deduction because there is a loss. So 15,000 is a loss in our example, and that loss is eligible as terminal depreciation under section 32. You are eligible for that deduction, terminal depreciation. Why can't you claim it? So instead of loss, a business loss, you claim the deduction here itself, and it becomes part of current year's computation of income. So accordingly, before you go to the term of loss, you are eligible for this deduction, right? So we claim this deduction as terminal depreciation. Okay. Yes. Now we come back. We come back to section 35AD. Now 35AD is another such lengthy section which well compares with section 35. In section 35 we saw about 10-11 deductions. Here also we are going to have about 12, 13, 14 deductions, and fortunately here for all the categories of claims, the deduction available is 100%. There is no distinction between 100 and 150%. No weighted deduction. You are eligible for 100% deductions. Now here, this 35AD specified business, and you are entitled for 100% deduction on expenditure incurred on an acquisition of capital asset other than land, building, right? So you should be, this is again an incentivized provision for setting up different categories of business. They are there on the screen. And you can see, in general, you can understand that mostly the incentive under this section, the logic of having this section in the Income Tax Act or providing this incentive in the Income Tax Act, that the government wants to promote the infrastructure. These are mainly for infrastructure development things. You can see now laying and operating a cross-country natural gas, crude or petroleum pipeline, setting up warehouse facility for agriculture, cold chain facility, 2-star hotel, then hospital with at least 100% beds, then slum redevelopment or rehabilitation under the approved such program, then affordable housing scheme which is approved, then setting up and operating an inland container depot or container freight station. You have beekeeping and production of honey and beeswax, production of fertilizer in India, setting up and operating semiconductor wafer fabrication, developing, maintaining any new infrastructure facilities, then warehousing facility for storage of sugar specifically, and you have finally laying and operating a slurry pipeline for the transportation of iron ore, right? So in general, we try to remember if or whatever incentives given or this incentivized deduction is for setting up infrastructural things, right? Now, but there are problems because you need to remember it very well. You must know the nuances, small details of the provisions of this section. Just like I explained you in case of section 35, यहाँ भी आपको problem आ सकती है because you will be tried to be confused, or the questions that will be asked in the examination will be little dicey. For example, here you are given यहाँ देखो कि warehousing facility for agriculture purpose, ठीक है? Now you can refer your manual and where the question is asked regarding the warehousing facility was set up for an edible oil. Okay. Now there warehousing facility for edible oil will not be considered to be agricultural produce, or it will not be considered to be agricultural purpose. It's because manufacturing edible oil itself is a business activity not connected to the agricultural activity. If you are producing pulses from where or seeds from whom the oil can be produced, so storing up those pulses as seeds, then fine, those the agriculture crops storing, you will eligible for this certified deduction, but not for oil industry, storing of oil warehouses. So these are the small things which you must be able to remember, and that is how you are expected to answer the questions on the small thing. So that is why I tried to categorize again, just like section 35. Here also I have tried to make an effort for the students appearing for the examinations, and try to make it put them in a different baskets. If you remember the baskets now, hopefully you should be able to remember even those things. Okay, now just look at the screen. Warehousing facility, setting up and operating. Now it is available for two things. One is agricultural produce and second is sugar. Now it is not available for any, just like I told you an example, edible oil नहीं है, उसकी warehousing facility के लिए आपको deduction 35AD में नहीं मिलेगा. You are not able to get the deduction for any other things, any produce for that matter. It is available only for agricultural produce and it is available for sugar. Now, if you set up a manufacturing facility for sugar, is it available? The answer is no. Whatever is production in India with respect to this fertilizer, honeys, beeswax, and activity of beekeeping, and a notified manufacturing production facility for semiconductor wafer fabrication. Now, semiconductor wafer fabrication, it has got to be a notified production facility. Please understand this. Fertilizer, no need to get notified. Honeys, activity of beekeeping or production of honey or beeswax, no need to notify, no need to get notified. But when you talk of semiconductor wafer fabrication, then you must be a manufacturing production facility which is notified. You can be any type of assessee. There is no restriction in the form of organization. This is the third category. So we have seen warehousing, agriculture produce, and sugar. Production, manufacturing, only three: fertilizer, honey, beeswax, and activity of beekeeping, and semiconductor wafer fabrication. In case of semiconductor wafer fabrication, you must remember one more thing. It must be unnotified production facility. Now there are third category which I have made is proper infrastructure projects for the general public utility. So it can be developing and maintaining and operating, or developing, maintaining and operating any new infrastructure facility. If you want to claim the deduction for this, then you must be a company. Any other category of assessee not eligible for this deduction. Developing, maintaining and operating, or developing, maintaining and operating. तीनों में, if you are a company and you are doing this for a new infrastructure facility, then you will be able to get the deduction of 100% of the expenditure on developing this new infrastructure facility under section 35AD. Then slurry pipeline for iron ore. Again, this is infrastructure project. Anybody can claim the deduction 100%. Inland container depot or a container freight station. Anybody can. Cold chain facility. You can get cross-country pipeline network for natural gas, crude or petroleum oil, and any internal storing facility. Here you have to be a company or consortium of companies. Okay, you have to be a company or consortium of companies to get the deduction. This is with respect to infra projects. The third basket I prepared. On the fourth basket, I have this named H because all these things starts with H. Just to make you make it easy for you to remember, I said H. Okay, there's nothing, no other meaning for H because all this hotel has to be 2-star anywhere in India. Sorry, यहाँ एक mistake हो गया है. Hospital has to be 100 bedded and not 1000 bedded. I will correct it later on. Hospital 100 bedded anywhere. Then housing project for slum development, it has to be notified. Then notified housing project with respect to affordable housing scheme. So hotel, hospital, housing project, slum development notified, housing project, affordable housing scheme notified or approved. So all this H will be eligible for 100% 35 AD incentivized deduction on all the capital expenditure other than land building, right? So here this slide tries to make your remembering the things from the examination point of view slightly easy. If you find this easier, adopt this. I am trying to make this categorization, just trying to remember. There is no other meaning to it. Earlier one is proper, this one is simplified way of remembering just for your sake from the examination point of view. If it helps you, I'll be happy, right? Okay. Now what are the other deductions for section 35 ED deduction limit? It should not the undertaking should not be formed by splitting up reconstruction. You know that there must be new undertaking. Then plant and machinery for which you are claiming 100% deduction should not be should be new actually, should not be old. यहाँ भी एक mistake हो गया, should be old, should not be old. However, following is treated as new. Okay, the meaning can be made out. That second hand imported machinery, the machinery which is imported from out of India and is not anytime in India, and no depreciation allowance has been granted on such depreciation. Such machinery anytime under the Income Tax Act, those conditions. And out of the total plant and machinery, 20% of the value of the plant and machinery can be old. Then expenses on land, goodwill and financial instrument is not eligible for deduction. Expenses on building is definitely eligible because देखिए ना 2-star होटल में मेजर क्या होगा, then हॉस्पिटल में मेजर क्या होगा, एक्सपेंडिचर 100 बेडेड हॉस्पिटल में मेजर क्या हो सकता है, हाउसिंग डेवलपमेंट प्रोजेक्ट फॉर स्लम डेवलपमेंट नोटिफाइड, उसमें मेजर क्या होगा, बिल्डिंग होगा. सो बिल्डिंग विल बी एलिजिबल, ओनली लैंड, गुडविल एंड फाइनेंशियल इंस्ट्रूमेंट्स you will not be allowed. Then that 40A3 condition applies here, that expenditure in this category cannot be incurred otherwise than through prescribed modes, that means through banking channels. If you incurred in otherwise than through prescribed mode, that is like in cash or bearer check, then you will not be eligible for that portion of the expenditure. Then if you have claimed expenditure under section 35 AD, then you lose out on other category of expenditure. Those are under section 10AA chapter 6A under the heading deduction in respect of certain incomes. You will not be eligible. Chapter 6 heading C of chapter 6A is deduction in respect of certain income, that is like ATIA, right? ATP, those deductions which are computed on the basis of the income earned, or the income based incentives or deductions which are available under heading C of chapter 6A, those you will not get. Then loss for specified business can be set up against another specified business under section 73A. This you should understand, because this cannot be set up under any regular business. It has to be set up under the income from the specified business. Now specified business may be not eligible, but still will be. Suppose you have a specified business which is eligible for deduction under section 35 AD, specified business which is not eligible for deduction under 35 AD. It has to be a specified business. Eligibility is different. So once it is a specified business, eligibility or non-eligible, you will be still able to set it off. Then No further deduction of section 32 depreciation will be allowed because you already claimed deduction of 100%. No double deduction, that is to be understood. And asset acquired should be used for specific purpose at least for 8 years. If asset is transferred, then the income from income from the sale proceeds from that asset will be considered to be income from business or procession. That will be taxable at PGBP income. And deduction is allowed only if accounts are audited. Okay, so audit is compulsory. The other conditions under section 35 AD which you must understand, and accordingly you should be able to answer the questions on section 35 AD. Then next is section 35 CCA. This is 100% deductions for contribution to National Fund for Rural Development and National Urban Poverty Eradication Fund. Once the deduction is, this is a contribution. So once the deduction is allowed under this section, no further deduction under any other section. National Fund for Rural Development, NFRD, and NUPEF, that is National Urban Poverty Eradication Fund. Contribution to these 100%. Expenses for rural development projects undertaken by these two institutions. Expenses for rural development projects undertaken by these two institutions. Section 35 CCA you will be entitled. Then section 35 CCC Agricultural Extension Project. Agricultural Extension Project 35 CCC is a weighted deduction 150% agricultural extension project. What is this available for? Weighted deduction of 150% of expenses incurred on notified agricultural extension project except on land and building. Please remember, except on land and building. Notified agricultural extension project, you are entitled for 150% weighted deduction of the expenses incurred on such agricultural extension project notified. Other than on land and building, no other deduction, maintenance of books of account and audit of them, then submission of the audited accounts and audit report to the Commissioner of Income Tax on or before the due date for filing the return, along with a note on project and certificate of Ministry of Agriculture. All these conditions have to be satisfied, and as the case that from assessment year 21-22, all weighted deductions, all enhanced category of this thing, they are going to go, and you are going to get only 100% deduction. That is 35 CCC for 2021, 150% weighted deduction, notified agricultural extension project, expenses incurred on it other than on land and building, right? Agricultural extension project. Okay. Now, okay, there are some questions, but okay, I'll answer them little later. Kristen wants me to reduce my speed. Okay, I will be little slower. Okay, Kristen? Yes. Section 35D now. Preliminary expenses. Section amortization of preliminary expenses. Section 35D. Typically, 1/5 of the preliminary expenses incurred by Indian company or any resident non-corporate assessee is eligible for 1/5 of the deduction for 5 years, 1/5 each year. That is how we amortize the preliminary expenses under section 35D for the purpose of computation of income under the head PGBP. And so simple preliminary expenses, as we all understand it, that expenses incurred for the formation until the commencement of activities of the business. 1/5 is allowed. It is allowed to Indian companies and resident non-corporate associates also, but there are certain condition of say audit of the books of account is required for non-corporate assessee. 1/5 every year for 5 years amortization. Now look at the expenses that are eligible. For company, expenses incurred till commencement of business, and in case of new unit or extension, expenses incurred till the completion of extension or of the new unit. Okay. Then eligible expenses, project report, feasibility report, expenses incurred for preparing or getting prepared, obtaining project report, feasibility report, market or other type of survey reports, engineering services, legal charges for adopting agreement relating to setting up of the business. So these things you understand that I'm trying to set up the business. I'm trying to understand the feasibility of the project, and in that connection I am incurring various type of these categories of expenses. I am eligible for their amortization 1/5 every year. But in case of companies, I am eligible for further some categories of deductions, and those are expenses on legal charges and printing of memorandum of association MOA, articles of association AOA, then ROC registration fee, ROC is register of companies registration fees, expenses in connection with issue of shares or debentures. So these are the additional categories of expenses which companies are entitled to for amortization 1/5 every year. Now, can this be any amount of which 1/5 I claim every year? The answer is no. The ceiling is 5% of the cost of the project. You have a project report prepared. So what is the cost of the project? Of that, 5% can be your overall entitlement of the expenses as preliminary expenses allowable under section 35D, and this 5% is to be amortized over a period of 5 years, 1/5 each year. That is the condition. But for companies there are two ceilings, and whichever is higher you are eligible. For companies, either the 5% of the cost of the project, which is otherwise applicable to other assets, and 5% of the capital employed. Now, capital employed is a general term which we use in the ratio of ROC, return on capital employed. Capital employed includes net worth plus long-term borrowings. So that is the definition of capital employed, and accordingly 5% of the cost of the project or 5% of the capital employed, whichever is higher, is what the company will be entitled to as a ceiling on the preliminary expenses, which can be amortized under section 35D 1/5 each year. All right. And audit, I told you that for non-corporate resident assets, audit would be necessary to claim the deduction. There is no separate category of report to be submitted, but you must get your books of account audited. That is necessary. Okay. Now, for example, you want to claim deduction under section 80I, then you must not only get your books of account audited, and also you should submit through your auditor. You should submit a report under section say 10 CCB. Form 10 CCB you have to submit. For example, a charitable trust, you are getting the books of account. Not only you are getting the books of accounts audited, but you 10B audit report. But here there is no such report, any form to be uploaded as audit report by a chartered accountant in case of section 35D. You just have to get your audited. That is the condition. If all for, you must be able to produce the audited accounts along with the audit report. And in case of amalgamation, the resulting, that is amalgamated company, will continue to get the deduction for the balance period left. 5 years is the duration. In this 5 years, suppose 2 years away, the amalgamating company already enjoyed. Now the amalgamated company gets merged into or amalgamated into amalgamated company, which is the resulting company. So the resulting company, amalgamated company, will get it for the remaining period of for 5 years, right? Okay, next. 35 CCD is expenditure on skill development, which is expenditure not in the nature of 35 CC and 35 CCD. 35 CCC was expenditure on notified agriculture extension projects, and 35 CCD is expenses on a skill development project. Okay, and these are both must be notified. Skill development or agriculture extension, both must be notified. Eligible assessee in this case is company. Deduction 150% for up to 2021, but from assessment year 21-22 again it is getting reduced to 100%. Deducting not available if the same is reimbursement. Somebody is subsidizing you, then to that extent you will not be able to get the deduction. Maybe it is government or your holding company which is subsidizing the expense on skill development. Deduction is not available if training commences after 6 months of recruitment. Okay, skill development has to start within 6 months of recruitment of the person. So then only you will be eligible for this deduction. Books of account necessary, and furnish following document before due date of furnishing the return of income to CIT or Director of IT. Somebody asked me the question, what is CIT in section 35CC? CIT is Commissioner of Income Tax. Particulars, Principal Commissioner of Income Tax nowadays, or Commissioner of Income Tax. So, short form is used Director of Income Tax or Commissioner of Income Tax. Audited accounts, an audit report, and amount of deduction claim. Those particulars have to be for there. They have to be there for claiming eligibility for claiming the deduction. 35 CCD expenses on skill development, not in the nature of land and building. 35 CCC we saw expenses on extension agriculture project, and here 35 CCD expense on skill development, 150% at both the places for this year, assessment year 21-22, 100%. Maintenance of books of account and other land and building not eligible. All those are common things which should able to remember. 35 DDA. So before I'll complete this first. Okay. 35 DDA is again same like 35D. 1/5 every year. Amortization. Okay. Concept will be amortization. Every year, whatever expenses you incur, their expenditure was 35D was preliminary expenses. Prescribed categories of preliminary expenses. There we saw what? Fees preparation, expenses on project report, feasibility report, market or other type of service. Those reports or any legal expenses for drafting any legal agreement for starting the business for all the categories. And for companies, drafting MOA, articles of association, registration fee with the ROC, and expenses incurred in connection with the issue of shares or debentures. There is an additional category. 5% of the project of the cost or 5% of the capital employed, whichever is higher for the companies. For other assets, 5% of the project cost of the project. 1/5 every year. Non-corporate assets, books of account to be maintained. Section 35D. Now we are 35 DDA. Expenses on voluntary retirement scheme, VRS. Expenses on voluntary retirement scheme. This section has gone on expanding, giving its eligibility for deduction. पहले तो ये सिर्फ universities kind of things के लिए था, company के लिए था. Then बाद में it has been extended to any type of. So as of now, it is available, eligible. Any SSC is eligible. Even an individual, if he has VRS expenses incurred, then he is eligible. Payment to employee in connection with voluntary retirement scheme. Deduction available is 1/5 of the expenses in the previous year, and next 4 years 1/5 remaining. In case of amalgamation, balance period that we saw in case of 35D, the same concept apply here, and no deduction of the same expenses under any other section. Okay, double deduction not allowed. That is always there. Okay, so this is section 35D. All right. Now, before I take section 36, because section 36 and section 37, these are two very important sections in PGBP. Those are to be discussed very in detail, and very interesting discussion that follows for both this section, because that section 36 as such has so many subsections. Each section is giving specific deductions for specific expenses. Okay. Before that, I will take whatever the expenses, whatever the questions that are there. Meenakshi from Tamil Nadu is asking me a question. How can we identify section 41? Okay, how can we identify section 41? Section 41 has 6 subclauses. Okay. Now section 41(1), in fact, I think I'm going to discuss section 41, Meenakshi. I'll not discuss this. I have a separate slide for section 41, so we will discuss it at that time. Okay, it comes after thereafter. In sequence, it is done. Okay, we'll discuss it at that time. Then Palak from Gorea is asking me, sir, what is actual cost in case of second-hand asset? Actually, what do you mean by second-hand asset? I suppose it's an asset which, suppose a second-hand car I purchased from a other person. Now he sells me, say, for 2 lakh rupees. It is whatever his cost of acquisition, what is his return on value, all those things are not concerned. If it is a third party or arm's length transaction and I purchase it for 2 lakh rupees, a second-hand machine or a second-hand car is purchased by me for 2 lakh rupees, then actual cost for me is 2 lakh rupees. For me it is 2 lakh rupees, and accordingly I start claiming depreciation on 2 lakh rupees. But there is one more thing that I must tell you, which we discussed, which is an explanation section, which is in the form of an explanation, I suppose explanation 3 and explanation 4, where if in the opinion of the assessing officer, a undue benefit is tried to be obtained by an assessee by arranging the transaction in such a way that it looks okay, but they are actually sham transactions. So in that case, then the assessing officer has the authority to overlook your whatever structuring of the transactions, and the returned on value in the hands of the transferor can be the returned on value, may be the returned on value in the hands of the transferee. For example, my friend has used the machine or the car for say 10 years. Okay, it is almost a scrap car, right? But because he's my friend, I tell him, bhai, you are going to scrap the car. Why don't you show the sale to me for 2 lakh rupees? So you show the sale to me for 2 lakh rupees, and I will claim the depreciation on this 2 lakh rupees, so that I can get the benefit of depreciation on this 2 lakh rupees. It can be 2 lakh rupees, or a machine can be of 2 crore rupees for a company. Actually, the value or the real value of the machine is zero. It has been fully exhausted. But the transactions are arranged in such a way that the value in my books, the sale transaction is shown in my book, or the purchase transaction in my books is shown at say 2 crore rupees, and I start getting depreciation on 2 crore rupees. That is an undue benefit I am claiming. Assessing officer has to overlook this transaction, and you say that I will take the return on value, the actual cost in your books in your hand at zero, because it's a sham transaction. You can say so. Sir, what do you mean by, who is this? Ayushi Jaiswal is asking from Lucknow. Sir, what do you mean by semiconductor wafer fabrication? Semiconductor wafer fabrication is a component which is there in your computer. यार laptop में रहता है, all computers में रहता है. This is what is the electronic gadget necessary part in the semiconductor, right? So that is wafer, means you understand a small thin piece of plastic, that is wafer. So that is semiconductor. Semiconductor means that is all this. It forms a part of all the circuits. Maybe it is a laptop or computer or any other. So it can be also in the TV also, right? So that is what is semiconductor wafer fabrication means. Preparing that and getting it fabricated. That is what I mean. Okay, I am a chartered accountant. I don't know much, but this is what I can understand from semiconductor wafer fabrication. You can Google it and find out more. Sanjay from Noida is asking, so once deduction is availed under section 35D, there will not be any deduction under section 32 for the same asset. Is that right? Yes, that is absolutely right. But is additional depreciation and terminal depreciation allowable or not, if not applicable? No, it is not available. Once you are claiming 35D, none of them is available. Okay, I explained. Aditya Gupta was asking me CIT, I explained that. Yeah, that's it. Janvi Agarwal, you are asking me derivation under section 35 CCC within 5 years. I didn't get you what is 5 years, because 35 CCC is, as I told you, it is agricultural extension project, 150% in the year of incurring the expenditure, and from AY 21-22 it is 100%. I didn't get your question. If you can ask me once again, I'll be able to answer this. Okay, so whatever questions on my screen in the box I have answered. Now let's go back to section 36. Friends, in the chapter of PGBP, section 36 is a very specific sections which mentions deductions available specifically on those categories of expenses. Okay, now those categories of expenses, let us understand one by one. It is not that important for you to understand the sub clauses of section 36(1). But yes, I have mentioned them. Let's try to understand them one by one. First is insurance premium. Insurance premium paid for risk against damage, destruction of stock and stores. Yes. Then, so okay. Now insurance premium. Insurance premium for the damage, destruction of machinery is available under which section? And insurance premium against the damage, destruction of the building is available under which section? And insurance premium against the damage and destruction of this against the risk of damage and destruction of stock and stores. So we have a building insurance, we have plant and machinery insurance, we have a furniture insurance, and we have a stock and stores insurance. But all these insurance premiums I am incurring, you can understand they are incurred for the purpose of my business, securing against the risk of damage and destruction. And the deductions I generally understand, being a student of income tax, I generally understand I should be able to get the deduction of this insurance premium because the expenses is definitely incurred for the purpose of business. But as a CS student, of income tax, I must know the sections under which deductions for these different types of insurance premiums for different assets available. As I told you, for building, it is section 30. For plant and machinery and furniture, it is section 31. Now, here we have stock and stores, stock or inventory, all types of inventory or consumable stores and spares, etc. Then all that insurance premium against this risk is eligible for deduction under section 36(1)(1). Then premium paid for life of cattle by Federal Milk Cooperative Society, 36(1)(1)(a), Roman 1A. Then premium paid by employer on the health of the employees, it has to be other than in cash mode in the approved schemes, then it is eligible for deduction under section 36(1)(b). Okay. Then 36(1)(2), bonus or commission paid, but it should not be in the lieu of profit, distribution of profit or dividend. It is bonus or commission paid to employees. It should be not an appropriation of the income or of the profit. It should be actually charged on the income or profit. Difference between charge on the profit and difference of and charge on profit and appropriation of profit. Charge on profit, above the line expenditure. Appropriation of the profit, below the line. Okay, in the profit and loss appropriation account. Charges are all in the profit and loss account. Appropriations are all in the profit and loss appropriation account. So any distribution of profit in the form of dividend or otherwise, it is an appropriation of profit. But bonus and commission paid to an employee because of the employer-employee relationship and not for any other reason, then such bonus and commission is eligible for deduction, but it is again subject to section 43B, which we are going to see little later. Section 43B के साथ इसको पढ़ना चाहिए. There is another condition to be made that we will see. Section 36(1)(3). Okay, section 36(1)(3). It is interest on borrowed capital for business purposes. Interest on borrowed capital for business purposes. It has to be a capital borrowed. An individual cannot get deduction of interest on his own capital. Okay, but a partnership can get the deduction for interest paid on the partner's capital. So in that sense, it is a borrowed capital. Okay, but here we are talking about borrowed capital and interest on capital paid to the partners on their capital loan or any other current account, etc. That deduction is available under a different head, subject to certain restriction there that we will see separately. And there is one provision which has been inserted to section 36(1)(3). And this provision is very interesting, which says that interest for capital assets shall be capitalized till the asset is put to use. That means I purchase a machinery for which I give the order today and the loan is disbursed to me today itself, that is on 20th September. The machinery actually comes on 31st of December. I start using it on from 1st of January 2021. So whatever interest I paid from today to 31st of December 2020 is the interest which pertain to the period prior to putting the asset to use. Now this we understand from the accounting point of view that this is a capital expenditure. This is a actually forms part of the cost of the asset and should be added to the cost of the asset, and we should be claiming depreciation on this part of the asset from the date the asset is put to use. And the same concept, the same logic is incorporated in this proviso under section 36(1)(3). Now previously there was one phrase used in proviso to section 36(1)(3) that interest on capital asset acquired for extension of business. Interest on capital asset which is acquired or put to use by the assessee for extension of business. Now this extension of business has been removed. It has been deleted by an amendment in the Income Tax Act. So you now use or acquire any asset, whether there is an extension of any business, setting up a new industrial undertaking or whatever. The moment you have a capital asset, whatever may be the reason for it or whatever may the implication of it on your business, interest on the capital borrowed for acquiring this asset or for construction of the asset till the date the asset is actually put to use has to be capitalized as per the provision to section 36(1)(3). And the converse of this is that explanation 8 to section 43 is that you cannot capitalize any interest which pertains to the period post the commencement of utilization of the asset. That means in our example, any interest from the period from 1st January 2021 to 31st March 21, that cannot be capitalized, that cannot be added to the. Why would one want to capitalize it instead of claiming the deduction? There can be a reason. For example, an individual is entitled for basic exemption of 2,50,000 rupees. Now, if he does not want to lose that exemption by showing loss, then in that case he would want to capitalize it, that interest. But that is not allowed as per explanation 8 to section 43. Then next is there any restriction on the rate of interest that I pay? Because borrowed capital means borrowed from anybody. It can be from the private person, or it can be the bank, or it can be financial institution. Suppose I borrow capital at say 24% from a person, and I'm paying interest at the rate of 24%, say, or at 36%. Is there any restriction? The answer is simply no. There cannot be, the rate of interest cannot be questioned by the AO unless the borrowing is from a related party and which falls in the restrictive categories of section 48(2)(b), which we are going to see little later. And accordingly, these all small thing nuances of section 36(1)(3), interest on borrowed capital, deduction for interest on borrowed capital has to be seen. And discount on ZCB, that is zero coupon bonds, allowed on pro rata basis. That means whatever discount I purchase a bond for 5,000 rupees, of which I am going to get 50,000 rupees at the end of say 15 years or 10 years. So this is the way the zero coupon bonds are issued. No interest is allowed every year. No interest is paid every year. But 5,000 rupees is getting matured after 10 years for 50,000 rupees. This difference of 45,000 over a period of 10,000 rupees will have to be allowed as a deduction for the issuer on pro rata basis, that is discount on zero coupon bonds. It is a form of interest, but the structuring of transaction is this way, is in the form of zero coupon bonds. Okay. Next, 36(1) small Roman 4a, contribution to new pension scheme as referred to in section 80CCD. 80CCD pension scheme by the employees. Now it is available for any other category of persons. Even contribute, the deduction is available up to 50,000 rupees separately, and if it is 80CCD-A1, it is forming part of that 1,50,000 rupees under section 80CCC. And if it is under section 80CCD-1A, then additional 50,000 rupees you are able to claim the deduction, contribution to new pension scheme, right? So that is 80CCD from the employee or any taxpayer point of view. Here it is the contribution in the form of a employer, and if as an employer I am contributing to new pension scheme, which is referred to under section 80CCD, then as an employer I am entitled for deduction for that contribution to new pension scheme on for the employees, but it is restricted to 10% of the salary. 10% is computed like HRA, basic plus DA, Salaries definition is basic plus DA in the terms of the employment so provide. So that is with respect to employer's contribution, assesses contribution as employer to new pension scheme under section 80 CCD. All right. To section 36(1)(4) and 5, contribution to employees recognized provident fund, approved superannuation fund, and approved gratuity fund. Particularly 36(1)(4) regarding gratuity fund, there are three conditions that you must understand it. Gratuity fund must be set on a trust. Contribution have to be periodic payment and not it's one-time payment. It has to be a periodic payment, monthly, 6 monthly, or annually, and fund to be for the exclusive benefit of employees. Then you are eligible for 36(1)(4)(5). 36(1)(5)(a) is one of the most litigated sections in the Income Tax Act. Now, 36(1)(5)(a) talks of the employees contribution to any welfare fund. Now here, what mechanism of say provident fund, working of provident fund? In provident fund, employee is expected to contribute certain amount, and employer is required to contribute certain amount. Then both the contributions are credited to the employee's provident fund account, and when he achieves the superannuation, he retires, he dies, then he is entitled to the proceeds of the provident fund. So we understand here that there is employee's provident fund, employee's contribution and employer's contribution. As far as small 5a is concerned, we are talking of employee's contribution, which is deducted from his salary. So what is there here? If I am as a salary to an employee and I am deducting 2,000 rupees salary, I am paying him 8,000 rupees and I am paying 2,000 rupees to the respective provident fund account. So where is the question of income or expenditure in my case? Because instead of paying him 10,000, I am paying him 8,000 rupees and 2,000 rupees provident to the provident fund on his account. So anyway, I am paying 10,000 rupees. So I should be entitled for 10,000 rupees. Of any such section to be there in the income tax. So let us try to understand the very logic of this. The very logic of this is employers, if they deduct, for example, in this case that instead of 10,000 rupees, I am deducting 2,000 rupees, I am paying 8,000 rupees to the employee, but 2,000 rupees I am not paying to the provident fund in time or not at all paying. In that case, I am enjoying somebody else's money and it is illegal, unlawful, right? I should be penalized. I should be penalized under the respective act, and at the same time, I should not be given incentive by way of deduction. Because in my books of account, what will be the entry? 8,000 rupees paid to employee, 2,000 rupees an expenditure as in the form of contribution, salary only, but 2,000 rupees I will be showing in the liability side as a contribution payable. But in profit and loss account, 10,000 is debited, I will be claiming deduction of 10,000 rupees. The question is, should I be allowed the deduction of 2,000 rupees? Or should there be any restriction? So putting the restriction on the employers, allowing to take any undue benefit of this 2,000 rupees. Income Tax Act has various provisions, and these provisions are in the form of section 224(10), section 43B and section 36(1)(5)(a), which we are seeing right now. What is section 224? Section 224 defines income in an inclusive manner. Income includes 1, 2, 7, 8, 9, 10. Now number 10 is employee's contribution deducted by the employer from his salary. Employee's contribution to funds set up for the welfare of the employees deducted from his salary. So in our example, 2,000 rupees is the deduction. Under section 224 subclause, the clause 10 of section 224 tells us that this 2,000 rupees will be considered to be the income of the employer. First of all, it is income. First, it is income. It will be income. 2,000 rupees is my income. And it will be allowed as deduction only if it is paid within the due date of the respective act. Now, Provident Fund Act says that you must pay the employer and employee's contribution by 15th of the next month. By 15th of आज चल रहा है September salary is paid on say on 30th of September. Then the Provident Fund contribution of employee as well as employer must be paid by 15th of October. That is the due date prescribed on that. So what are any contribution? So you understand the concept now? Employee's contribution 2000 becomes my income first as employee. And I will be allowed deduction of that 2000 rupees only if I pay it by 15th of October. That is 15th of the next following month within the due date as prescribed under the respective act. Alright. Now the question is 2000 rupees income हो गया, उसके बाद 2000 rupees expenditure हो गया. So there is no effect on my profit and loss account. 10,000 rupees is the salary which I paid. So I claim 10,000 rupees as deduction. 2000 becomes my income. 2000 becomes my expenditure. Is paid by 15th of the next month. So income minus expenditure, zero effect. What happens if I do not pay it by 15th of the next month? Do not pay it by 15th of the next month, then I will lose the deduction of this 2000 rupees permanently. That is the interpretation attributed by the income tax department and the statute and the CBDT. So if I happen to pay this, I have deducted it has already become my income. 2000 rupees has already become my income under section 224(10). Now, can I claim the expenditure of this 2000? The answer would be no. It is not paid by 15th of the next month. It would remain my income and I deduction of it permanently. Now, there is a lot of legal dispute going on this issue. Some high courts, about 5-6 high courts have been telling in favor of the assessee that it paid after the due date, that is even if it is paid after 15th, but if it is paid before the due date for filing the return as per the provisions of section 43B, the assessee would be entitled for deduction even for the employee's contribution. It interpreted it very strictly and they say that once you miss this 15th deadline, then you lose the deduction permanently. The law is still evolving and there is no clear-cut law laid down as of now by the Supreme Court, but so far as various high courts now. For example, I am from Maharashtra. I have a Bombay High Court jurisdictional decision in the case of Gadge Party Industries Limited. Of the section 43B, section this deduction for employees' contribution, even if not paid by 15th of the next month, will still be allowed to you. So, the lot of gray area. As far as you as students are concerned, you must know this that you should consider that it has to be paid by 15th of the next month. That is the due date as per the respective act. If not, it will be not allowed to you. Section 36(1)(6). This is with respect to dairy industry or poultry industry or piggery industry. For that matter, any industry based on the animals where you are having livestock as your asset. Now here, stock is not fixed asset on which you are entitled for depreciation under section 32. In section 32, we have seen that what are the classes of assets. Classes of assets, plant, machinery and furniture, and we have intangible asset, technical know-how and all those things. So tangible may building, plant, and intangible, technical know-how, patent, copyright and all those things categories they for 32. But livestock is not there as a class of asset. You are not entitled for deduction of depreciation. There is no rate of depreciation prescribed for livestock. But livestock also deteriorate. A milching cow will stop giving you milk after some. A buffalo will happen. They may not be of any use to you because they become old. They may not be useful. So what happens? So this a cow for 50,000 rupees for my dairy, and at the end of her life, say after 10 years or 15 years, she stops giving me milk, and the I need to sell her because income. So 50,000 rupees cow I sell for 5,000 rupees at the end of her production period. So I sell for 5,000 rupees, 50,000 rupees I purchase, 45,000 rupees is the expenditure, is the loss, the money which I have lost over a period of time. This 45,000 rupees, I will be able to claim the deduction under section 3615 on realizing the sale proceeds of rupees 5,000. I am not entitled for depreciation, but I am entitled for this type of deduction with respect to when I sell the animal that dies while it is with me, then if I carcass of that animal. So whatever amount realizes from the sale of the animal or carcass of the animal, the difference between the cost and the sale proceeds, I will be entitled for deduction under section 3616. And now 3617 bad dates. We all understand this, bad dates and BDDR. There is a difference between these two. Bad dates is actually writing off the debt as being bad, and BDDR, as that is bad and doubtful debts reserve, is just a contingent provision that we apprehend certain percent of our portfolio of debtors is going to be bad or it does not get recovered over a period of time. That is our experience. So BDDR provision is not equal to bad debts. There is a difference we must understand if we do not know right for the time being. Then we should know this. Those who don't know must know this, that bad debts and BDDR are different. BDDR provisions are not allowed except to the financial institution, that is 3617A, that is 8.5% of your income or 10% of the agricultural advances, subject to the total provision not exceeding twice the amount of your paid up capital reserve. That is 3617A. But 3617 is with respect to bad debts. Bad debts written off, what are the conditions? Debt or loan should be written off in the books. Debt or loan, green one, there is one line I have written, ICD's impact on this condition, that we will see little later. Debt or loan should relate to the business of the assessee. Yes, debt and loan should have been taken into account in computing the income, same or for earlier year. And deduction of is allowed this year in which the bad debt is written off. And in addition to 3617, there are many other conditions under section 3612, and these 3612 conditions are written under the other aspects. Upon recovery, if there is any increase in bad debt, the same shall be deduction. For example, I sold goods for 10,000 rupees to a person and he paid 4,000 rupees, and for remaining 6,000 rupees there is a dispute going on. Now this 6,000 rupees I write off from my books of but I feel or rather I felt in earlier years that okay, another rupees from that time and remaining 3,000 there is a dispute, I admit definitely not get it. So 3 years off, only 3,000 rupees. Out of 10,000 rupees, 4,000 rupees I recovered. Out of the remaining 6,000 rupees, I feel if 3,000 कभी भी recover होगा नहीं, so I claim the deduction of bad debt of these 3,000 rupees, suppose 4 years before. Now today the dispute is settled and the fellow said that I will not pay you at all. I will just pay you 1,000 rupees. भाई तेरे को मैं 1,000 रुपए दूंगा, we'll settle the account. So 4 years before, so I had claimed a deduction of 3,000 rupees. And there was 3,000 rupees outstanding in my books of account. And out of these remaining 3,000 rupees which were outstanding in my books of account, I just recover 1,000 rupees. Remaining 2,000 is a bad debt today. I must write it off today in from my books of account. Then I will be able to get the deduction of it. Right? Now, then recovery of bad debts is taxable under section 41(4), definitely. Because I write it off as expenditure and I claim it as an expenditure at the write-off of bad debts. But if it is recovered, then it will be income under section 41(4). So shortfall in bad debt will be allowed as a deduction, and recovery of the bad debts will be treated as income under section 41(4). And so allow hands of the successor. That means I have a debt. My proprietary concern gets converted in the hands of in an LLP or in a private limited company. That private limited company can also claim the deduction of bad debts for debts incurred by me as an individual. Okay, so this is the concept of successor, right? Uh, yes, Nidhi from Pune wanted me to take the break. What is the break time? Okay, another 6 minutes. We will exactly break at 8:30, and we will finish the remaining portion of section 36, and we will take a break, and thereafter we will start. Nidhi, all right? Today is Sunday. You all guys are there for this lecture on Sunday morning at 7 o'clock. That's up to you, because this is the crux of the CA course. This is the devotion that a CA course needs. If all you guys are there on Sunday morning at 7 o'clock for hearing me on this virtual class, that means you have this dedication, you have this devotion, you have this attachment and involvement in the subject, and the desire to become a full-fledged chartered accountant. This is the urge, this is the boil in the stomach that makes you a full-fledged chartered accountant. Those who have it, you deserve to be a full-fledged chartered accountant. Those who don't have, God bless you. Okay. We are going to take a short break, little, but we'll finish this slide. I suppose after this slide, we are going to section 37. Am I right? Yeah. So we'll finish this slide. 3619 is an expenditure on family incurred by, expenditure on family man. Only company assets are eligible. Again, this is like 35D, the capital expense will be allowed every year. But for the part of the deduction for like unabsorbed depreciation, there is no restriction on it. But profit on transfer of such asset, in the same manner it will be deducted like scientific research. Accordingly, it's a very old provision. 3619 is very old provision. India actually has a policy which was on the forefront planning. I suppose, as we all understand it, government has no focus as of now on the family planning or the restriction of the population as such. We don't find that mentioned in any government manifesto or any government advertisement declarations. But once upon a time, government had a full thirst on family planning, controlling the population of our country, and at that time, this provision came into being in the Income Tax Act, and accordingly, deduction is allowed for expenditure incurred on the family planning on the employees, only for the companies, because companies' accounts are getting audited otherwise under the Companies Act. In respect of capital, we are going to amortize it 1/5 every year, and accordingly, for the capital expenditure, you are treating like unabsorbed debt. There is no restriction on it, and carry forward. It will be carried forward in the subsequent years without any restriction of number of years, and it forms part of the current unabsorbed portion forms part of the current year's claim, and the profit or loss on the sale of transfer of such asset is treated in the same way like the scientific research we have seen the table format. How? Because if full depreciation is allowed and the asset is sold, then entire sale consideration will be income. 36.115, in between sections have gone. They are either omitted or lived their life. They are more relevant. 36.115 and 36.116 are same. Deduction in respect of security transactions tax paid by the assessee while dealing in securities, and it is the trading in shares or securities, and trading in shares and securities is business income from business or profession, then security transaction tax will be allowed to him as deduction. Similarly, if an assessee is dealing in commodities, then such dealing is liable to commodity transaction tax at 0.01%, and commodity trading is definitely taxable as income from business, and as business, and accordingly it is you are getting the deduction, and the commodity transaction should be actually paid by the seller, and able to get the deduction of tax if the income is taxable under the head income from business or profession. And the last one is with respect to ICDS, marked to market loss or other expected loss as computed as per ICDS 36.118 row Roman 18, it has come from 1st April 2017, that is from assessment year 17-18, along with the notification of the ICDS, which is available for a person having income from business or profession following mercantile system of accounting. Then income has to be only as per section 28 to 43D, but also as per the provisions of section ICDS. Now ICDS, mark to market loss. Let us try to understand. Expected loss तो किसी भी नहीं मिलता है आपको, because it is a contingent expenditure, contingent liability. ICDS specifically says so. But mark to market loss, that means if I am holding the shares or securities as my current investment, as my stock in trade, then I can mark them to market values at the fag end of the year, as at the date of close or as of 31st March. Then in such cases, mark to market loss will be allowed to me as per the ICDS provision. But if the shares or securities are held by me as investment, long-term investment, then mark to market loss will not be allowed to me. So these are the provisions of ICDS. Here 36(1)(18) tells us that such mark to market losses will be allowed only as per the provisions as per the ICDS. ICDS are not there for intermediate course. They are available. They are there for final course. So we are going to study them, all the ICDS for that matter, at the final level. For the time being, we just understand this, and mark to market allowed under the ICDS, then only it is allowed. Otherwise, it is not allowed. There is one important thing which I forgot, which I wanted to tell you, but I forgot to tell you before I stop. ICDS impact and this condition regarding the bad dates, because I remembered this because of the ICDS. For example, in contract, there is a concept of security deposit. There is a concept. Suppose a contract of 1 crore rupees is executed for construction of the building, and the contract says that 10% will be the security deposit, 10% security deposit with me for next 10 years. Next 10 years, the building has to remain proper, intact, and after the period of this indemnity period of 10 years, I will repay you this 10%. The 10%, that is 10 lakh rupees after 10 years. Now, what is the accounting treatment in my books of account? As per the accounting standard, 90 lakhs rupees will be my income and 10 lakh rupees will not be my income. I will not consider them, because unless and until the indemnity period, the guarantee period, or this period of warranty of 10 years gets over, that will not form a part of income. But ICDS 4, which is on construction contract, says that this 10 lakh rupees security deposit will form part of my gross turnover. Now, suppose there is something happens. See, 10 lakh rupees I have shown as security deposit. 10 lakh rupees I have not shown as part of my turnover in my books of account. But the income tax ICDS tells me that this also has to be considered as part of my turnover, and accordingly I have to offer this for the purpose of computation of income. Understand this 10 lakh rupees after the end of 10 years, in between, suppose during the period of say 10 years the building, and I am not able to recover this 10 lakh rupees security deposit. If I am not able to recover this security deposit, then though it is not accounted in my books of account as a receivable, though it is not accounted in my books as a receivable, still it has become irrecoverable, and in my earlier years computation of income, I have shown that as an income. Now, for the purpose of claiming deduction under section 36(1)(7), to claim a deduction as bad debts, the first and foremost condition is that I must write off this debt from my books of account. I must write off this debt from my books of account. It should have been taken into account in computing the income. If it is taken into the books of account, as per ICDS, I have considered this as part of my turnover. I have shown my turnover of 1 crore rupees for the purpose of computation of my income as per the requirements of ICDS. So this 1 crore rupees, that 10 lakh rupees is forming part of my income. But in my books, this 10 lakh rupees I have not showed as sundry debtors. So because I have not shown that as sundry debtors, I cannot write it off. Okay, there is no question of writing it up from my books of account. But I will not be able to fulfill that condition of writing it up. But ICDS, there is a separate provision inserted in section 3617 that if any income has been recognized because of the provisions of ICDS and that income in the subsequent year becomes irrecoverable, then you need not fulfill the condition of writing off it from books of account, because that condition is practically not compliable. And such income which is not accounted for in the books of account but offered to tax in the computation of income because of the provisions of ICDS, if such income, you write, such income has become irrecoverable, it has gone bad, then you will be able to claim the deduction of such income, such irrecoverable income, even without meeting the condition of writing of it in the books of account. That is what is the ICDS impact and this condition. This I wanted to explain. Okay. Now here we stop. We are at 8:35. We take a break of 5 minutes. We will be resuming our lecture exactly at 8:40, and from 8:40 we will continue up to 9:30. So for the time being, we take a break, 5 minutes break, and then we will come back again. All right, Mr. Vijay? Hello? Yeah, 5 minutes break. We start at 8:40. All right, we stop. Okay. Before I start the next section, that is section 37, I'll answer some questions. Yes, Janvi Agarwal is asking me, in case of employer not paid within 15 days, then employer has to pay 2000 rupees to employee because it is lost to employee. Yeah. Uh, it is a debate in itself. Even if the employer does not make the deduction, still he has to pay 2000 rupees. And if he deducts 2000 rupees and does not pay to the fund, then it is lost. Definitely it is lost to employee, and it is a loss to employee not only of 2000 rupees but also another say 2000 rupees which he has to pay from his own pocket. The employer has to pay his own contribution, right? So these are also there. Both 2000 rupees his contribution, 2000 rupees employee's contribution, both is the loss to the employee, and for that there are penal provisions getting attracted under the respective act. There are stringent provisions, so they will be taken care of at that time. Janvi Agarwal is asking, if taken deduction of bad debt but money is received after deduction, I told you section 41(4) applies and recovery of bad debts is taxable as income from business or profession under section 41. Saikat Das from West Bengal is, sir, please tell about recovery of bad debts. Yes, Saikat, this is what it is. If you are writing off it as bad debt, then subsequent years, it is not that once you write up from your books of account, it is not that you have given up your right for recovery. I mean, it doesn't mean that you have forgone your right of recovery. Okay, means you owe some money and the person doesn't pay you, and you have filed a legal case against him, and he because he is not paying you, you write it from the books of account. You are eligible for a deduction, but you can at the same time you can continue your recovery proceeding in the court of law, and if the recovery proceeding does result in some recovery in future years, then that recovery will be taxable to you, taxable in your hands under section 41(4). Understand this very important concept, which I think forgot to tell you regarding bad debts. Is it necessary for me to prove before the income tax officer that the debt has actually become bad? Is the responsibility there on me that this is the bad debt and I have written off it in my books of account? Is there any other condition that I must fulfill? Is it necessary? Is there an onus on me? Is there a responsibility on me from the income tax assessment point of view that I must prove before the assessing officer that this debt has actually become bad? I have taken reasonable efforts for recovery of this debt. I have tried to file a suit. I have filed a recovery suit against this person for recovery of bad debt. Do I have to produce the exchange of letters between me and the debtor before the income tax officer as a proof of my recovery efforts? Nothing of, let me tell you, nothing of this sort is required. In fact, the only condition for claiming the deduction of bad debt is to write off the debt from my books of account. The debt which I have taken into account in the same year or in earlier year while computing my income from business or profession, then that debt, the only subsequent condition that I must fulfill is that I must write off that bad debt from my books of account. There is no onus, there is no responsibility on me to prove that the debts are bad. There is no responsibility, there is no liability on me. The income tax officer cannot put an additional burden on me asking me to prove that the debt has become bad. Is it necessary? There is one more issue. Is it necessary that I must wait at least for 3 years? Because 3 years is the general laws time limit. After 3 years, I forgo my claim automatically. Is it necessary that I must wait at least for a period of 3 years before I write off the bad debt? There is no such condition. There is absolutely no such condition. I can write off the bad debt in the year in which I have sold the goods to him. I have sold the goods to him to this month. Next month we have a dispute as of the year end, as on 31st March 2021, I find that this debt is not recoverable, I can write that off. There is no minimum time period for which I must wait. There is no that sort of condition. One cannot read in between the light, or one cannot read something in addition to what is there in the Income Tax Act. Income tax is the legal fiscal statute. It has to be read accordingly. It has to be interpreted accordingly. All right. So therefore, strict interpretation follow. What is the condition in the books of, what is condition in 3617? That I must, the date should have been taken into account while computing my income, and the date should have been written off from my books of account. I fulfill these two conditions. There is nothing more. Nothing more can be cast upon me, and that is why the vice versa. That is why section 41(4). Okay, you write off, you claim the deduction, but whenever you recover, please offer it for taxation. So both the situations are taken care of. That is what is second. This is recovery regarding the recovery bad debt. Rakshana V from Chennai, please explain 3615 again. Okay, as I was not audible. Okay, fine. Rakshana, I hope you are now listening to me. I am trying to explain 3615 once again. See, look here. 3615A, one small 5A, versus section 224(10). Both have to be read simultaneously. Section 224, which defines income, clause 10 of it says that any contribution, employee's contribution deducted from the salary. In our example, 10,000 was salary, 2,000 rupees is the employee's contribution which is deducted. This 2,000 rupees is deemed to be the income of the employer. In the first place, it becomes an income of the employer. 10,000 rupees salary, 2,000 rupees deducted, it becomes my income. And I will get the deduction of this 2,000 rupees only when I make the payment. And what is the another condition? Another condition is that this 2,000 rupees, I must make the payment of it by the due date of the respective statute as prescribed in the respective statute. Provident Fund Act says that I must make the payment of the employer and employee's contribution by 15th of the next month. September ka salary hai, it is paid on 30th of September. I must make the payment of the employer and employee's contribution to the Provident Fund by 15th of October. If I do not make the payment by 15th of October, I lose the deduction of employee's contribution permanently. As far as employer's contribution is concerned, I can make the payment of employer's contribution not essentially by the due date of the respective statute, that is 15th of October, but even if I make the payment by say 31st of July or 30th of September, still I will be able to get 31st of July 2021. Employee's contribution 2,000 rupees, I must make the payment by 15th of October 2020 to get the deduction. But another 2,000 rupees, which is employer's contribution, if not paid by 15th of October, still, even if I make the payment by 31st July 2021, that is the due date for filing the return for non-audit cases, and 31st October 2021, which is the due date for auditable cases, if I make the payment by the 31st July or 31st October 2021 of employer's contribution, I will be able to get the deduction under section 43B. I am talking of employer's contribution. Employee's contribution 3615A. Or deduction only if it is paid by the due date of the respective statute. That is, in our example, September salary 15th of October. Otherwise, I miss 15th of October, I lose the deduction permanently. That is what is 3615A. Palak from Gora is asking what is commodity derivatives. Commodity derivatives is there are commodity exchanges, and in commodity exchanges you have the underlying value derived from certain commodities like gold, silver, zinc, copper, all those. Those are derivatives which are available to be traded on these commodity exchanges, and those can be traded and accordingly like a shares, like stock shares derivative. Similarly, there are commodity shares. There is a value derived from the shares is a derivative of shares. Similarly, there is value, there is commodity value derived from the commodity, there is a derivative. Then, sir, please explain the reduction of explain interest on borrowed capital 3613. Palak, I think I have given a lot of time on 3613. If it happens, if the time permits, I will take on. Otherwise, I think we need to move on. Okay. Yeah, I think the queries for the timing answered. Now we take section 37. Section 37. Section 37. Let's understand that. Section 37 is one of the smallest section, but the widest implication. It is a residuary category of deduction of expenses which is available. Okay. Small section, but very, very, very wide meaning of it. Okay. Now, Leslie, we have seen section 30 to 36. How far? All of the in-depth discussion from section 30 to what are the categories of section 30? Repair, vagera on building. Section 31, machinery, plant and furniture, insurance premium, repairs, rate, vagera. So all those section 32 depreciation, 32 AD we have seen, 32, 35C, 35D, 35C, 35, all those directions up to section 30. Just now we discussed section 36. Now section 30 to 36 name specific expenses deductions of which is available. Section 30 to 36 specific mention of specific deductions, specific expenses, specific claims, specific contributions. Deductions available. Right. The expenses which are not mentioned, which are not getting covered between the sections from 30 to 36, and such expenses which is laid out or expended wholly and exclusively, please understand this, wholly and exclusively for the purpose of business or profession, is what is eligible in the residuary category of section 37. Wholly and exclusively for the purpose of business or profession. Okay. Wholly and exclusively. Please understand this. Wholly and exclusively for the purpose of business, not under section 30 to 36. So for understanding section 37, you must know what is there in section 30 to section 36. Scientific research आपको मालूम होना चाहिए, 35AD स्पेशल इंसेंटिव आपको मालूम होना चाहिए, प्रिलिमिनरी एक्सपेंशन 35D आपको मालूम होना चाहिए, 3617 यानी कि बैड डेट्स आपको मालूम होना चाहिए. I mean each and every small thing, interest 3613 interest on borrowed capital आपको मालूम होना चाहिए. So all these things you must know, and if you find that any expenses which is not covered under section 30 to 36, then consider this whether it is incurred wholly and exclusively for the purpose of business or profession, then it is eligible for deduction under section 37, that is the residuary category. But there are three important aspects that before we go to the general discussion of wholly and exclusively, we understand this first three categories. Such expenditure should not be in the nature of any offense or prohibited by law. Explanation 1. Such expenditure should not be in the category of this, that it is an offense. It is an offense or it is prohibited by law. You will not be allowed as a deduction, even if it is for the incurred wholly and exclusively for the purpose of business. Let us take an example. You know, builders and developers, successful builders and developers. Hindi cinema में हम देखते हैं, we see in the Hindi movies that these builders and developers, they are big shots, earning a lot of money, very rich people, and so they have always the problem of ransoms getting recovered from them, and so therefore they seek protection from rowdies or all these people from the society who are doing this illegal business of giving illegal protection. So a builder pays a protection money to a gang of criminals. भाई मुझे कुछ करना नहीं, इसके लिए आपको ये पैसा जो करना है आप और लोगों को कीजिए, लेकिन you will protect me from yourself and you will protect me from other rival gangs. For that I am paying you this, say 5 crore rupees as a ransom every year, but you will protect me, my business from all those things. Now I am paying 5 crore rupees. If you understand this, it certainly is an expenditure which is incurred wholly and exclusively for the purpose of business. But is it legal that I hire a criminal gang for protecting me and paying 5 crore rupees to them? Now it is an offense. You cannot. It is not allowed. It is prohibited by law, and therefore this 5 crore rupees, which otherwise is an expenditure laid out and expended wholly and exclusively for the purpose of my business as a builder developer, but not allowed. Not allowed because it is an offense. It is not allowed by law. This is the meaning of this explanation 1. Let us take one more example. Suppose I am a bank and I am supposed to follow, say, certain norms, certain rules, regulations prescribed by the Reserve Bank of India. For example, as a banker, I must obtain all the KYC documents of the bank. That is, know your customer. You know that now? KYC, know your customer. Why Reserve Bank has bought in? The Reserve Bank has bought in because there should not be, money laundering, terrorist funding, all those things should not be there. Or black money flowing in the banking system. That should not be there. So that is why the bankers are under the responsibility to identify each and every customer with the KYC norms, and they must obtain the relevant identification documents of the person before the account is opened or before any transaction takes place with that customer. KYC documents must be obtained. Suppose a bank has flouted that. Bank has not followed this and they have not obtained the KYC documents. So the Reserve Bank in their inspection find that the bank has flouted this, and the Reserve Bank imposes a fine of 50 lakh rupees on their bank for not following KYC norms. Now the Reserve Bank imposing 50 lakh rupees, which is a fine, imposed by Reserve Bank of India for breach of any rules or regulations. This fine of 50 lakh rupees will not be allowed as deduction under this explanation. Okay. Now, let us understand one more thing. Now, suppose I do not file my GST return in time and I do not pay the GST in time. Okay. Now, my return of GST is not filed in time, and either the GST is not paid under GST 3B in time, then I am paying some interest and I may be paying some fine also, now it is capped to 500 rupees. Now this is a late fee, they call a late fee. So far as the interest portion of the delayed period is concerned, I am required to file my GST 3B return in a particular time, and if I do not file it, then there is a breach of some rule by me. There is a breach of rule. But is it an offense? Can I not file the Form 3B under the GST? Is it prohibited by law? The answer is no. Then what about the interest that I pay? Interest is something which is compensatory in nature. So interest paid on delayed payment of GST, interest paid on delayed payment of any excise duty, custom duty, those interest being in the compensatory nature, then they are allowed as deduction. They are not hit by explanation 1. But if any penalty is levied, any amount is recovered from you, which is not in the nature of compensatory for a period of time, but it is because of the breach of rule, breach of any provision of the GST Act, or for that matter, breach of any provision of the Customs Act, then that expenditure is not allowed to you, because that is straight away hit by explanation 1. Now, we must try to distinguish between the two. Which is in the nature of compensatory, and which is in the nature of penalty or fine, which is because of breach of any rules or regulations. So compensatory nature, interest, and penalty and fine. So this should be distinguished, and accordingly explanation 1 to be interpreted. Then there is explanation 2, which specifically says that expenditure, every company with a turnover of 5,000 crore rupees or net worth of 500 crore rupees, or every company which is earning profit of not less than 5 crore rupees, then each of such company under the Companies Act is expected to spend 2% of its net profit, at least 2% on the net profit on the CSR activities, that is corporate social responsibilities. These are the provisions as per the Companies Act and the Companies Act corporate CSR rules. Now, any expenditure which is incurred as per this on the corporate social responsibility by the company, whether the deduction of this is allowed, the answer is no. Okay, the answer is no. I have written here what is the rationale that this deduction is not allowed. See, I have, what is my profit? My profit is 10 crore rupees. Okay, now 2% of it, 20 lakh rupees. I must spend 20 lakh rupees on corporate social responsibility. That is what do I do is spend it for? I will spend it for helping the society. Environment के लिए कुछ करूँगा, students के लिए कुछ करूँगा, education के लिए कुछ करूँगा, health, अभी कोरोना चल रहा है, for corona I will do something for helping the general society. So this is how I spend the amount on corporate social responsibility. So I am spending for the general society 20 lakh rupees. The company is spending 20 lakh rupees for the benefit of the general society on education, health, the corona pandemic, or whatever, education, family planning, providing educational facilities, donation to various charitable trusts who are engaged in this type of activities. Is it not good? Is it not for the betterment of the country? Is it not for the betterment of the society? So should I not be allowed deduction for this? What is wrong in allowing deduction for me this? Okay, now let us understand this. What is my profit? My profit is 10 crore rupees. This is what I was trying to explain you earlier. Charge on the profit and appropriation of the profit. The expenditure of 20 lakh rupees is not charge on your profit. It is appropriation of profit. And because it is appropriation of profit, deduction of it is not allowed. Deduction of the expenditure which is charge on profit above the line, that only is allowed. That means appropriation means what? You earn income 10 crore rupees, you pay tax on it 25%, 2.5 crore rupees plus surcharge, education cess, whatever it is, and whatever remaining, that 7.5 crore rupees is what is the amount of profit available for you for appropriation. Or from that you are spending 20 lakh rupees. You are not spending from 10 crore rupees, you are spending from 7.5 crore rupees because it is considered to be an appropriation of profit. And because it is appropriation of profit, deduction of it is not allowed. That is the rationale behind explanation 2, not allowing the deduction of expenditure on the activities relating to corporate social responsibility. But explanatory memorandum to Finance Bill 2014 says that if the expenditure is in the nature of section 30 to 36, that means for incurring corporate social responsibility, you have borrowed some funds and you have paid interest on it, the deduction of which is allowed under section 36(1)(3). For doing corporate social responsibility, you have constructed a building from which you want to conduct the activities. On that, you are claiming depreciation under section 32. You will be allowed the deduction. It should be in the residuary category. The expenditure should be in the residuary category. Then only you will be restricted the deduction under explanation 2. If you are falling in any deduction which is specified, mentioned from section 30 to 36, you will be allowed the deduction. That is what is the implication of explanation given in the explanatory memorandum to Finance Bill 2014. That is what. And next is any advertisement in any souvenir, brochure, tract, pamphlet or the like published by a political party. Section 37(2)(b) specifically stops you from claiming the deduction of it. Political party advertisement in any of their publications in any manner. Now advertisement, I can advertise my product anywhere. I can advertisement in newspaper, I can advertisement in any magazine, television, hoardings, or for that matter, I say that this political party, they are distributing so much of their manifesto. It is in crores of copies. It is going all over the country. So it is the easiest way of advertising. So I say to a political party, please print this advertisement on your manifesto back page or front page. I will pay you for this. Typically speaking, Had it not been a pamphlet or manifesto of a political party, then it is definitely an expenditure incurred wholly and exclusively for the purpose of my business. Because I am not advertising because of the political reasons. I am not advertising because of any other considerations. I am exclusively advertising in the political party's manifesto only because I am going to get the mileage of advertising from that advertise. But still, Section 37 2B starts with a non-abstante clause. Please understand this, non-abstante clause. It means that it starts with the wording notwithstanding anything contained in Section 37. Notwithstanding anything contained in Section 37. Notwithstanding means non-abstante clause. उसमें जो भी कहा गया हो, फिर भी अगर आपने, if you advertise in the brochure, souvenir, etc. of any political party, we will not be allowed the deduction of it. Okay, so we have seen the gamut of Section 37, residuary expenses, and accordingly we discuss this. Now let us come here. We will see some small nuances. Incurred by the assessee for business in accounting year, incurred after the business has to be settled. It should not be a personal purpose. It should not be a capital expenditure, and donations are not allowed. Just now we discussed charity donations. They are a good thing for the society, but donations are donations. They are appropriation of profit. They are not charged on profit. They are not allowed. Now, I am taking one issue, very interesting issue. Pharmaceutical companies, to advertise their medicines or their products, normally who is the ambassador of their product? It is the doctor, right? That is why there are medical representatives. You see when you go and see when you go and visit a doctor, you find that medical representative waiting for meeting the doctor, because it is a medical representative which comes from the pharmaceutical company. He explains the benefit and he requests the doctor to prescribe that particular medicine, and that is how they promote their thing. And to get into the good books of the doctors are given various types of freebies, various types of things to be put on the table. They are given various articles. They are given many other things like hosted dinners and all other parties. They are allowed foreign travel and all those things. Okay, fine. There is a way how the pharmaceutical companies try to promote their medicines and capsules, tablets, etc., whatever. And that is how they try to be in the good books of the doctors, so that they keep on prescribing the medicines, because otherwise the medicine cannot be sold, because you and me as a layman, we don't know the medicine. Medicines, only doctors know. So it is the doctor who prescribes, and then only sale can happen. And if the doctor does not prescribe, the sale cannot happen. It is the doctor who must prescribe. So that is why it is very much necessary for pharmaceutical companies to be in the good books of the doctors and make them prescribe their medicines in most of the cases. But what happens, CBDT Circular 5 of 2012 says that just like chartered accountants, we have code of conduct, right? We have rules of ethics and we have code of conduct, and accordingly we must follow that. Similarly, for other professions like doctors, there is code of conduct which is prescribed by the IMC, that is Indian Medical Council. Indian Medical Council controls the profession of medicine. They are the authority, supervisory authority for the purpose of doctors. Now, as per the guidelines of Indian Medical Council, something which is given to the doctors. Now, doctors are given all these freebies, that they are given articles, they are given according to the IMC. This is not ethical. This is unethical. And that is why Indian Medical Council prohibits such freebies to be given by pharmaceutical companies to the doctors for getting their this thing prescribed, for getting their medicine prescribed by the doctors. So the expenditure on freebies by the pharmaceutical companies to the doctors is something which is prohibited by the Indian Medical Council, and therefore Indian Medical Council, just like Institute of Chartered Accountants of India, is established under Chartered Accountants Act 1949. Similarly, Indian Medical Council is also a body set up for supervising the doctors under a separate act, and therefore they also have a statutory authority. So they have prescribed that you cannot give any freebies to the doctors, and if you give, then it is violation of the code of conduct prescribed for the doctors. So that is why CBDT circular number 5 of 2012 says that any freebies given by the pharmaceutical companies to the doctors is in violation of the guidelines by the Indian Medical Council, and because it is in violation of guidelines by the Indian Medical Council, expenditure on the freebies by the pharmaceutical companies will not be allowed. Now, I am giving you an example of decision of Bombay ITIT in Medley Pharmaceuticals Limited, which is very recent decision. I am giving you this decision, my students, those who are listening to me. I want you to explain this. I am going into the small details, further details in this, even though the time doesn't permit me. But I am giving you this example just you to understand how the law should be interpreted. How much deep we should go into the law and accordingly try to interpret it. Okay. Now, I have told you a background that Indian Medical Council, which supervises the working of doctors, it prescribes code of conduct for doctors. Doctors are not allowed to accept any freebies from the pharmaceutical companies as an incentive for prescription of their medicines. So Indian Medical Council supervises doctors. Indian Medical Council, by the code of conduct prescribed, prohibits doctors from accepting the freebies. Now, in the case of Medley Pharmaceuticals Limited, the circular of CBDT number 5 of 2012 was challenged, and an argument was made on behalf of this pharmaceutical company that, look, the code of conduct prescribed by Indian Medical Council is for the doctors. The code of conduct prohibits doctors from accepting the freebies. So whatever violation of the IMC code of conduct is by the doctors. Am I a doctor? I am not a doctor. I am whom? I am a pharmaceutical company. What am I doing? I am producing or manufacturing medicines. I am selling those medicines, and in the part of my sales promotion activities, I am distributing these freebies to the doctors. Indian Medical Council Code of Conduct and Guidelines about the freebies do not apply to me. I am not a doctor. I am a pharmaceutical company. The code of conduct is for the doctors. They should not accept it. If they accept it, there is violation by them of the code of conduct prescribed by the Indian Medical Council. But Indian Medical Council guidelines are not applicable to me. The code of conduct issues are not applicable to me because I am not a doctor, I am a pharmaceutical company, and therefore you cannot make a disallowance in my hand of the freebies which I distributed to the doctors because I have not violated any law. Code of conduct by IMC is not applicable to me because I am not a doctor. I am not supervised by Indian Medical Council. Doctors to whom I give the freebies, they are supervised by they as a recipient are supervised by the Indian Medical Council. I as a giver, I as a pharmaceutical company, I am not supervised. So there is no violation by me of the guidelines by the Indian Medical Council, and therefore this deduction should be allowed to me. And this argument was accepted by the Bombay High Court in a very recent decision in July 2020, and the deduction on freebies by the pharmaceutical company in case of Medley Pharmaceuticals Limited was allowed as a deduction by the Bombay ITT, overruling what is stated by the CBDT in Circular 5 of 2012. So this is an example I gave you for understanding how the law is to be interpreted. Okay, and now I give you one more example of how the law should not be interpreted. How the law should not be interpreted. In one of the very interesting case, a lawyer, and the lawyer was none other than Mr. Shanti Bhushan, the father of Prashant Bhushan. Prashant Bhushan, you know that he has been in the news, 1 rupee fine and all those things. I don't go into that because that is not our area. But just to make you remember that this is the case in which the case is Shanti Bhushan versus income tax officer, and Mr. Shanti Bhushan. What was his claim? You can understand. A person's logic or thinking can go to what extent you can just imagine by this example. Mr. Shanti Bhushan claimed that the expenditure incurred by me on taking the care of my heart, on taking care of my heart is, उसको मैंने transplant किया है, उसको मैंने एक wall बिठाया है, or whatever treatment that I have given, and I have tried to keep it in functioning, because if the heart is not there, then I am not there, and if I am not there, then I am not as a lawyer, and if I am not as a lawyer, then I will not earn any income, and because if I am not there earning any income as a lawyer, there is no income tax liability. So for me, my heart is my plant. As a lawyer, for me, my heart is my plant, and any repairs and maintenance of that plant, my heart, should be allowed to me as a deduction. That was the claim. Can you imagine? Can you imagine a person going to such an extent and making such a claim? No, I'm not on a person. I'm on something that an imagination can go to such an extent, and people can claim deduction of even such expenses. Now, you and me, we are smiling. Can a heart be claimed as a plant? But there is a person who argued in this paper. Of course, the concept was not accepted. The case went up to Delhi High Court, and Delhi High Court also had to dismiss the petition of the Mr. Shanti Bhushan. He said that no, bhai, heart cannot be your plant, and we agree with all your arguments that yes, it is necessary. If heart is not there, you are not there, then your legal practice is not there, and if your legal practice is not there, then there is no income on which there is income tax liability. Yes, sab kuch accepted hai, but we come to the core issue whether your heart is your plant. The answer is simply no, and that is the distinction between something which is for a personal purpose and something which is for the purpose of business. There is a thin line. There is a thin line of distinction. Section 38 also we have seen. Something which is used for personal purposes is not allowed as deduction. But something which is used for your own business purposes is allowed as deduction. So this is what it is. And accordingly, we complete the discussion here on section 37. Section 37 is a big subject. I can discuss any number of, this type of examples, like we discuss about heart as a plant and repairs of it, and Medley Pharmaceuticals freebies, which is going beyond the circular and how to interpret it. Very interesting reading it makes, and accordingly one can spend as much time as on this. But okay, for the timing we stop here. We have tried to understand the gamut of section 37, not in 30 to 36. It is laid out wholly and exclusively for the purpose of business. It is expenditure incurred is not an offense, or it is not something which is prohibited in law. CSR activities expenditure is not allowed because it is an appropriation unless it is falling in the category of section 30 to 36. And finally, we saw that any advertisement in the political parties brochure, etc., it is specifically prohibited as section 37B, and then try to understand the gamut of section 37. We can discuss any. Okay, now section 38 we have seen partly partly for business, partly for personal expenses. Personal portion of personal expenses will be definitely disallowed, but please understand this red bracket, red square or red rectangle you just see. This portional allotment is applicable to rent, repairs, insurance of the building, repairs and insurance of the building. Sorry, machinery यहाँ आना चाहिए था. Rent, repairs and repairs of insurance. Section 31 is for machinery, plant and furniture. थोड़ा गलती है यहाँ. Building के budget instead of building, here it should have been plant and machinery. And depreciation. Only in respect to section 30, 31 and 32, section 38 is applicable. It is not applicable for any other expenses. Then we are trying to see some expenses which are not allowed now. We are going to see, so from section 40 onwards, we are going to see what are the expenses that are not allowed. Section 30 to 37, expenses allowed. Now we are going to see section 40 to 40A. We are going to see various types of sections which are not allowed to you as deductions. First, 40A, any interest, royalty, fees or any other sum which is payable outside India to a to a non-corporate entity or to a foreign company on which TDS is not deducted and or deducted but not paid. Okay, so these are subject to deduction. If the TDS is not deducted, you will not get the deduction. 100% expenditure will be disallowed. But if you happen to pay the TDS on it on any subsequent year, then you will be able to claim the deduction of it in the year in which you have actually paid the TDS. This is one. 40A or small Roman 1, let us say, is with respect to payment outside India to a non-resident, non-corporate or a foreign, non-corporate entity or a foreign company. 40A 1A is with respect to payment to resident without deduction of tax other than SAT. If any payment is made without deduction of tax, then 30% of such expenditure will be disallowed, but not 100%. 40A 1 100%, which is outside India to the non-resident. 40A 1A is to the resident without deduction of tax, 30%, but allowed as a deduction when in the year in which the TDS is paid. Suppose I did the payment today, but TDS I did not deduct. I make the payment in the next year, then I am allowed. Here, one more thing that you must remember, that this TDS, either under section 40A1 or 41(1)A, if not paid this year, but paid before the due date for filing the return, then also I can claim the deduction of it in this year. That means with this financial year going is 2021. Today I do the TDS, deduct the TDS. I have to pay by 7th of the next month. I do not pay it. I do not pay even up to 31st March 2021. But if I pay it by 31st July 2021, or if I pay it by 31st October 2020, if I am an earnable entity, then I will be allowed the deduction for the year previous year 2020-21 or assessment year 21-22. This is the 43B concept which we are going to see. That is allowed. Now, there is one more concept here which is introduced by way of a proviso from assessment year 2014-15, which says that where an assessee will not be deemed or an assessee will be deemed to be not in default, where the assessee will be deemed not to be in default under the first proviso section 201 subsection 1. Now 2011 talks about the interest to be paid by the assessee deemed to be in default for delayed payment of TDS. The provision there also says that it will not be deemed to be in default if certain conditions are satisfied. What are these conditions? These conditions that if the deductee or the payee, दोनों वही है, furnishes the return of income under section 139, he shows that income or that income which deductor pays him forms part of computation of his income. He pays the due tax along with the interest on the return income, and payer obtains or payee furnishes a certificate from the chartered accountant of the payee that ये सब हुआ है, that he has filed the return, he has taken into account this income in his computation of income and return of income, and he has paid the due taxes on it. These all A, B, 1, 2, 3 are getting certified by in form 26A. In form 26A. I am not saying 26A, yes. 26A. 26A, yes, is something in which all your details of tax payments, returns, etc. are disclosed. 26A is a certificate to be obtained by the deductor from the deductee or payee chartered accountant for having complied with the conditions of these things. If these conditions are fulfilled, then the assessee is deemed not to be in default. If the assessee is accordingly not deemed to be in default under the first proviso to section 2011, then he will be deemed to have deducted the tax and paid the tax in the year in which the return of income is filed by the payee or deductee. Abhi jaise, if I have paid 2 lakh rupees as contract charges. On that, I was supposed to make the TDS of 2% of 4,000 rupees. To say Mr. X, who is maintaining my office, he is cleaning my office, so I am paying him maintenance charges of 4 lakh rupees, 2 lakh rupees. But I failed to deduct 4,000 rupees as TDS. But I request I request that XYZ and company to give me a certificate from his chartered accountant that this 4 lakh rupees is forming part of his turnover, 2 lakh rupees is forming part of his turnover. He has taken that into account while filing the return of income. He has filed the return of income. He has paid the due taxes on it. Vagera, vagera, all these things are certified. So suppose I get a certificate from the chartered accountant of XYZ and company, to whom I have paid the maintenance charges of 2 lakh rupees, on which I have failed to deduct TDS of 2% of 4,000 rupees. And I obtain a certificate of their chartered accountant in form 26A. Online mechanism is there. So if I have this 26A, when can the chartered accountant of XYZ and company give me a certificate? When the return of income is only filed, he can give. So today's TDS, the certificate of the chartered accountant can come to me only after the return is filed by XYZ and company. Then only the chartered accountant of XYZ and company can give me a certificate in form 26A. So by no means, this certificate will come to me by 31st March 2021. Because 31st March 2021 will get over, the previous year will end, thereafter the returns will become due, and thereafter the return will came to be filed by XYZ and company chartered accountant, and then only the chartered accountant will be able to give me the certificate. Now, so therefore, essentially, the certificate in form 26A from the chartered accountant of XYZ and company will come to me only in the next year. And when the certificate comes to me in form 26A, then and then only I will be deemed to have deducted the TDS and paid the TDS. I will get the deduction not in this year, in 2020-21, even if it happens before the due date for filing the return, because I will be deemed not to have deducted the TDS this year. If I have not deducted the TDS, I will not get the deduction. I have to deduct the TDS and paid. Both the conditions must be satisfied. So I am deducting in the next year, because 26A is coming in the next year. I will get the deduction only in the next year, even if the TDS, even if the 26A certificate is received by me from the chartered accountant of XYZ and company before my due date of filing the return. Still, I will get the deduction only the next year, not this year. I will not be able to get the deduction. There is one concept which is discussed in the manual with respect to paid and payable, because section 40A1 and 41(1)A had the one in respect of any TDS paid or payable. In respect of any TDS, a tax deducted resource paid or payable. And the word paid has been removed, and only the payable word is now there in both the section. So therefore, it was an interpretation by the assessees that the TDS which has remained payable at the year end, for that only you can make the disallowance. And the TDS which has been paid, you cannot make any disallowance. That was the concept with respect to paid. This is with respect to expenditure and not with respect to TDS. Suppose 2 lakh rupees which I have already paid, 2 lakh rupees which I already paid during the year, for that this allowance will not apply. But suppose another 1 lakh rupees maintenance charges are payable as at the year end. The amount which remains payable as at the year end, disallowance will be attracted only with respect to such expenditure which is remaining payable as at the year end, only will apply. That was a limited interpretation which was taken by the assessees because of the specific removal or deletion of the words paid from the section. But the department has come out with a circular which is there in the screen, where we says that it will apply not only the amount which remain payable expenditure which remain payable at the year end, but it will also apply which is actually paid during the year. So that is a simple, and any expenditure incurred for that matter, whether paid or not, TDS default, the disallowance will get attracted. And on this, we take this last example, and then we will stop for the today, and accordingly we can do this discussion. This is on section 40A1 and we read with section 44AB and read with the TDS provisions. Let us see. This is the example from the manual only. Now, okay. Okay. Mr. Yuan Raja, same example, a resident individual whose turnover during the year ended 31st March 2019 is rupees 99 lakhs. Discuss whether any disallowance arises under the provisions of section 40A 40A1A in respect of the following payments. Interest of rupees 45,000 was paid to Rahman and Company, a resident partnership without deduction of tax at source. Rupees 3 lakh was paid as salary to a resident individual without deduction of tax at source. And commission of rupees 16,000 was paid to Mr. Vidyasagar, a resident on 2/7/2019 without deduction of tax at source. So interest of 45,000, salary of 3 lakh rupees, commission of rupees 16 lakh rupees. It was paid. Now I want you to tell me how much is the disallowance. I want you to tell me how much is the disallowance out of these three payments. We have three payments, 45,000, 3 lakh, 16,000. Okay, we have seen the provisions of section 40A. We discussed the details of section 40A and now this is the example for you to answer me the question. The one example which we are going to take today, it is already 9:30, but yes, I want to take this example and then only I want to finish this 40A. Can I have the answers from you guys? Are you there with me? I'm waiting for your answers. Let me see whether you can answer. I'll give you some time and then I will answer this and then we can stop. Yes, Sanjay from Noida is saying 1,08,300. How did you calculate 45 or 3,51,000? Is it that? 45,000 plus 16,000 plus 3 lakh, of that 30%, that is 1,08,000. Very good. On the face of it, Saikat Das is telling us that on the face of it, 30% of 1 and 2 is disallowed. Why not 30? Why not of third? Because commission threshold is 15,000 rupees. Any commission paid above 15,000 rupees is liable to TDS. So even 3 should be taken if the same logic is to be taken, right? Any other answers? Actually, this question is yes. Palak from Goria is saying 30% of interest, salary, and commission. So all 30%. Okay. So you are Sanjay and Palak, both of you are saying the same thing. At least one thing you understood, that 30% is the deduction for resident payments without deduction of tax at source. That is clear. But okay, this question is not essentially or section 40A, 40A1A. This question essentially is on TDS provisions. Basically, the expectation from this question is your understanding of the TDS provisions, whether the TDS is applicable or not applicable. For example, interest 45,000 paid to Rahman and Company, right? Now, interest threshold limit for others is 10,000 rupees. For bankers, it is 40,000 rupees for regular citizen and 50,000 rupees for senior citizens. Yes, Janvi Agarwal is saying 30% of the amount of salary paid without deduction of tax at source would be disallowed. In case 1 and 3, disallowance not attracted. Very good. But you must tell me the answer, reason. Yes, sir. Taikat Das is saying, sir, but my question is, who can deduct TDS if Mr. Individual is not liable to deduct tax at source, then sir? Okay, that is what I'm trying to explain. Okay, now let us understand this. The whole thing revolves around, the answer to the whole thing revolves around this turnover of Mr. this Yuan Raja, whose turnover is 99 lakhs rupees. Now, all the sections except section 192B says that in case of individual and HUF, if their turnover is more than 1 crore rupees in business and 50 lakh rupees in profession, exceeds rupees 1 crore or 50 lakh rupees for business or profession in the previous financial year, then they are liable to get their books of account audited, and therefore they are liable to comply with the TDS provisions. Means, if in financial year 2019 my turnover is more than 1 crore and above in business, or 50 lakh rupees in case of my business, then I am required to comply with the TDS provisions in financial year 1920, so long and so forth. So previous year I must exceed the turnover limits of 1 crore and 50 lakh rupees. If that I do, then only the next year I am liable for TDS provisions. And this is applicable only to TDS provisions other than salary. This condition is not there for salary. Yes, Janvi Agarwal, you are right. That is what you are saying. You are saying in case 3, commission does not exceed 50 lakh rupees, and in case 1, turnover not exceed 1 crore rupees. No, not that. Your answer is correct, but the reasoning is incorrect. The turnover of the deductor is more important, not the payment. Okay. For 45,000, the threshold is 10,000 rupees. Any payment in excess of 10,000 is liable for TDS as interest, and commission, the threshold is 15,000 rupees. Any commission payment in excess of 15,000 rupees, once it is exceed 15,000 rupees or 10,000 respectively, it is liable for TDS. Entire 45,000, entire 16,000 is liable for TDS. But the turnover of that person is to be seen, and individual and HUF is to be seen. If it exceeds 1 crore rupees or 50 lakh rupees, then only the TDS provisions are, he is liable to comply with those provisions, otherwise not. But this exception or this applicability situation is not there with respect to salary. Salary, whatever your turnover, it may be less than or it may be more than 1 crore rupees, you are still liable for compliance of the TDS provisions in respect of salary. So, in this case, Yuan Raja's turnover is less than 99 lakhs in March 19 year. So, in financial year 1920, he is not liable for doing the TDS under many other section. Interest 194A, he is not liable. 194H, commission, he is not liable. But 192B, salary, he is still liable even if his turnover is less than 1 crore rupees, and therefore only salary is liable for TDS 3 lakh rupees, and therefore disallowance will attract only in respect of payment of salary, that is 3 lakh rupees. 30% of it is salary TDS, that is 30% of 3 lakh rupees, 90,000 rupees. 90,000 is what which will be disallowed under this. Okay. Now, I want to take some MCQs for depreciation for another 10 minutes before we stop, and we will try to complete the MCQs if possible. Are you there? Now we can do some MCQs on depreciation. Depreciation, something we discussed on 17th of September. That is on Thursday last. On that I had MCQs, but I did not have time to take the MCQs at that time, so I am trying to take the MCQs now. Okay. Yes. Assessee had taken a building on lease and incurred capital expenditure on construction of any structure for his business. What about treatment of such capital expenditure? Yes. Invisible. Okay. Sorry. Mr. Vijay, now it is visible. MCQ depreciation now. जी, stop sharing करके. अभी देखिए विजय जी, अभी देखिए. ओके 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 ओके, यस. अभी अनविजिबल होगी. अभी भी नहीं दिख रही है विजय जी. ऐसे रहने थे. हाँ, ओके ओके ओके. अभी दिख रहा है ना विजय जी सबको? ओके 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 ओके. वापस चला गया. अभी देखिए, अभी दिख रहा है. ओके ओके ओके, ठीक है. देयर इज समथिंग टेक्निकल. ओके ओके. अभी दिख रहा है ना विजय जी? अच्छा, आई थिंक दिस इज व्हाट. अभी दिख रहा है सर? अभी दिख रहा है क्या? हाँ, एमसीक्यू दिख रहा है ना? ओके फाइन. Okay. Okay, guys. Now, okay, can we have the screen? There is everything on the screen now. There was some technical issue. I could not show this, but now it is visible. I am told. Assessee has taken a building on lease, rental income, a rental property, but certain expenditure is incurred, which is in the nature of capital expenditure. So, what is the proposition here? Can I get the deduction? Full capital expenditure disallowed or capital expenditure allowed, or the property does not, I'm not owning the property and therefore I will not be eligible for depreciation? What is the answer? Or none of the above? Yes, question C, I am getting one. आदित्य गुप्ता फ्रॉम वाराणसी, इस क्वेश्चन का आंसर उन्होंने सी दिया है. संजय फ्रॉम नोएडा इज सेइंग बी. यस. Capital expenditure on rented, leased property. Depreciation condition, I must own the asset, I must use the asset. I must fulfill both the conditions to be able to claim the deduction of depreciation. Here, the property is leased. I have taken that property on lease and I have incurred certain capital expenditure on it. Will I be able to claim the deduction of depreciation on it? Will the capital expenditure be allowed? Will the capital, being a capital expenditure, it will be disallowed? Yes, most of the people are saying option C, and only depreciation is allowed. The fairly simple question. Answer is option C. Depreciation will be allowed, and capital expenditure will not be allowed. Capital expenditure, there is being a capital expenditure, there is no question of allows or disallows. The only this thing is that you will be allowed the deduction of depreciation on the capital expenditure because it is a deemed building owned by you, deemedly owned by you, and therefore option C. Yes. Then we go to the next slide. Assessee company received an asset under amalgamation during the previous year and used in its business, but period of use in that previous year is less than 180 days. What about the treatment of depreciation for assessee company? That is, amalgamated company for current year on that asset. Current year on that asset. We are talking only with respect to the resulting company, that is amalgamated company. A getting merged into B, A no more there, B continues. Now B is the amalgamated company for us. Now B is using this asset for less than 180 days. Now what is the proposition of depreciation in the case of company B, amalgamated company? What is the allowance otherwise for it? Full depreciation, no depreciation, half proportionate, or proportionate depreciation on the usage of number of days. We have discussed this. It was forming part of our slide. And when there is succession of business from individual to say convert into private limited company, amalgamation, demerger, all these successions of business situations, in all these cases, what will be the amount of depreciation? Yes. Saikat Das from West Bengal is saying option D, that is half of proportionate depreciation. Sanjay from Noida is saying again half of proportionate depreciation. And Aditya Gupta from Varanasi is saying A, that is proportionate depreciation allocated on the basis of usage of days. A ratio will be allowed to it. Yes, any other answers? So B and C is not the option at all. Either it is D or it is A. Yes, Mansha from New Delhi, you are saying answer A. Yeah. Any more answers? Okay, fine. Right answer is answer A, because we have seen in the case of succession of business, the eligible depreciation has to be computed as if there is no succession of business, and this eligible amount of depreciation is to be appropriated or apportioned between the successor and successee in the ratio of the number of days for which the asset is held by the respective entity, the previous entity and the subsequent entity. So therefore the answer is certainly E. Okay. Then the third, Mr. Sunil, a retailer acquired furniture on 10th June 2019 for 10,000 in cash. 18th June 2019, 15,000 rupees and 20,000 by a bearer check and account pay check respectively. Depreciation allowable for AY 2021 would be, how much will be the amount of depreciation in this situation? 10,000 in cash, 15,000 by bearer check and 20,000 by account pay check. 10,000 in cash, 15,000 by bearer check and 20,000 by account pay check. What is the amount of depreciation that he will get on furniture? Let me tell you, the rate of depreciation on furniture is 10%. As per the Appendix A to income tax rules, the rate of depreciation on furniture is 10%. So what is the actual cost on which you will claim the depreciation at 10% in this situation? Yes, difficult, confusing. As far as account B check concerned, there is no problem. That means 20,000 rupees तो depreciation आपको मिलना ही मिलना है. There is no problem. Aditi is saying 4,500. You calculated 4,500 on entire 45,000 rupees of expenditure. 10,000, 15,000 and 20,000. So that makes 45,000. On that 10% is 45,000. Fine. Then Sanjay from Noida is saying answer is 2,000 because he is not giving depreciation on 10,000 and 15,000 rupees. Fine. Then yes, I have only two answers right now. Any more answers? Okay. Okay. Sakat Das from West Bengal is saying answer is option A, that is 2,000 rupees. Okay. Now let us understand this. Provisions of section 48(3) and for depreciation calculating actual cost, they apply if the expenditure, capital expenditure for acquisition of the asset is incurred otherwise than through prescribed modes only if the amount exceeds 10,000 rupees. Exact 10,000 rupees, it does not apply. Exact 10,000 rupees, it does not apply. And prescribed modes does not include bearer check. Prescribed mode does not include bearer check. And therefore, Mr. Sunil will not be eligible for depreciation on this 15,000 rupees which is paid by bearer check. 15,000 rupees paid by bearer check, he will not be eligible to claim the deduction on it because bearer check is not the prescribed mode and the 10,000 rupee threshold limit is also exceeded. But 10,000 rupees initial paid in cash and 20,000 rupees paid by account paid check, both would be eligible. So the actual cost here would be 30,000 rupees and on these 30,000 rupees, 10% will be 3,000 rupees. So the answer would be option B, that is 3,000 rupees. I have Mansha from New Delhi who has given the correct answer. And yes, Janvi also coming again, 3,000 rupees. And Janvi, you are saying 3,000 rupees. That's fine. Asset is used for more than 180 days. Yeah, 18 June, 10th June, 18th June, all those things. They are much before 30th September, rather 3rd October. And furniture, hai na? So you can immediately start putting to use immediately the day you purchase. So there is no question of any installation. But otherwise assuming that they are used for the full year, we can accordingly answer this. Okay, next. Here we are. Fourth one. Fourth one. Written down value of block. Plant and machinery rate of depreciation 15%. On 1st April 2019 is 3,20,000. A second-hand machine costing 50,000 rupees was acquired on 1st September 2019, but put to use on 1st 11/2019. No, it is during June 2019. During June 2019 or January 2020 लिखना चाहिए यहाँ. This should be read as 20. During January 2020, part of this block was sold for rupees 2 lakh. Then what is the amount of depreciation that you will be entitled to? 3,20,000. A second-hand machinery 50,000 rupees we purchased. on 1st September 2019, but it is put to use on 1st 11 2019. So what is the amount of depreciation? And 2 lakh rupees is the same. So what is the option? What is the correct answer? Yes. Opening WDV 3,20,000. New second-hand machine was acquired 50,000 rupees, but put to use for less than 180 days, guys. And there is a sale of 2 lakh rupees in January 2020, just about 2 months before the year end. So what is the amount of depreciation that would be available in this case? Yes, can I have the answers? $25,500 is the first answer I get from Janvi. Okay, any other answers? Okay, fine. Now look, yeah, 4 is A. Sanjay from Noida is saying 4A. That is option A, 21,750. Yes, Sanjay, this is the correct answer. 21,750 is the correct answer. The reason is something like this. 3,20,000 is your return on value. Okay. Of this, 2 lakh rupees is the sale. So 1,20,000 rupees. 50,000 rupees is put to use after for less than 180 days. So you will be able to get a deduction only of 7.5% of 50,000 rupees. So 7.5% of 50,000 rupees and 15% of 1,20,000 rupees. So 18,000 plus 3,750, that is 21,750 is the correct answer. This is a second hand machine, so you will not be able to claim the additional depreciation. Second, though it is acquired for more than 180 days, that is before 3rd October it is acquired, still it is put to use after 3rd October, that is being used by the assessee for less than 180 days, and therefore you cannot claim the deduction full on this 50,000 rupees. So therefore the answer has to be 21,750. Okay, Sekat Das has rightly said so, and Janvi, now you are coming right, 21,750. Fine. Okay, it's 10 o'clock, and the very last question that I'm taking, these MCQs I will share with you as PPT, but before we close, we take this as the last answer, last question. And slightly difficult one. I want you to attempt this, and we can see whether you can answer this correctly. Star Limited has return on value of machinery of 40 lakh rupees on 1st April 2019. It purchased another machine on 1st November 2019 for INR 14.40 lakhs and put to use on the same date. Star Limited was amalgamated with Universe Limited with effect from 1st April 2020. 1st April 2020. So Star Limited loses its existence from 1st April 2020. So therefore it can claim depreciation only up to 31st December 2019. So how much is the depreciation that can be claimed by Star Limited? How much is the depreciation that can be claimed by Star Limited? This is slightly difficult for all of you. But I must tell you, I can tell you the. देखते हैं, 1-2 मिनट रुकता हूँ. Anybody can answer this question. I will wait for 2 minutes. Yes, any answer? Yes. Slightly difficult one. This is slightly difficult one. Yes, January Agrawal is saying A and Aditya Gupta is saying C, that is 7,08,000. Yeah. Let me answer this. The option A is the correct answer. Option A, that is 4,94,162 is the correct answer. Now 40 lakh rupees, that is 15% of this is 6 lakh rupees. Okay. And 14.40 lakhs rupees, on that 7.5%. We are talking only of normal depreciation, we are not talking of additional depreciation. So 14,40,000, that comes to 15% comes to 2,16,000 rupees. The question is that this 2,16,000 rupees, the number of days are to be considered from 1st November 2019. So 1st November, यानी कि पूरा November is 30 days and पूरा December is 31 days. 61 days, out of how many days? You have to calculate the days in the year for the whole, from 1st November to 31st of March. That is November 30 days, December 31 days, January 31 days, February 29 days, and March 31 days. So total 152 days, right? 152 days. Out of 152 days, the new machine is used by Star Limited for 61 days. The new machine is used by Star Limited for 61 days. So 2,16,000, 14,40,000 into 15%, 2,16,000, 2,16,000 is divided by 152 into 61. Plus 6 lakhs rupees regular depreciation, that has to be bifurcated between Star Limited and Universe Limited in the ratio of the number of days from April to 31st December and January to March. So total number of days in the year are 366 because February leap year this year is, and February has 29 days. So 360 days, 66 days. So Jan, Feb and March, those comes to 91 days. Out of 366 days, 91 days will be belonging to Universe Limited. 275 days will be for the Star Limited. So for 40 lakhs, 6 lakh depreciation, proportionate is 275 divided by 366. Proportionate is 275 divided by 366 for 6 lakh rupees. That is on 40 lakh rupees. On 14.40 lakhs, we were eligible for 7.5% depreciation because the asset is used for less than 180 days. That is 1,08,000 rupees. On this 1,08,000 rupees, this is to be divided by, this is in the proportion of 61 to 152 days. This is in the proportion of 61 to 152 days. And therefore, the deduction will be available at 4,94,162 days. 4,94,162, and accordingly the answer is 4,94,162 is the right answer. Janvi has given even the bifurcation of the two, 458.20 plus 43,342, dono mila ke 494,162. She has rightly said on the two machines. Very nice, Janvi, you're done. And now we end with this last question. Kiran is asking me, in exam also this type of MCQ will come. Why not, Kiran? Why not? This type of MCQs will there be in the examination also. It can be even difficult than this. Why not? You are going to be a chartered accountant. We expect you to be expert in the income tax, which is one of the very conventional and core subject of the chartered accountancy syllabus. And you are expected to have the expert knowledge in this, and accordingly you will have to know this type of, you have to be able to solve this type of questions as well. Okay, so Kristen is asking when class is getting over. The class is getting over just now because it's already 10 and I was not able to solve these MCQs last time on depreciation. Some MCQs up to 5 we have solved. We have around 10 MCQs. I will share these MCQs with you on the website, so you can solve the remaining MCQs, and the remaining portion of profits and gains of business and profession, PGBP, we will take on 22nd morning, that is coming Tuesday morning at 7 o'clock. We will take the remaining sections of PGBP, and those we will accordingly complete this portion of profits and gains of business or profession. So today we stop, we close here, and we are going to start it again on Tuesday, that is on 22nd September 2020. Right? Alright, Fishaji, we can stop now. We can close? Yeah. Okay, fine.